Live. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan is back in Milan, here to take you through the rest of this hour. Futures market closes at 5 p.m. Eastern, 4 Central Time. If you're joining us on tastylive.com on the platform, thank you for joining us. Of course, you should come over to YouTube. Tell us what you're trading, what you think of today, this quarter, this year so far. It's certainly been a first half to remember. 3.5 more years left of this, guys. Maybe 4 more years thereafter of a third Trump presidency or Vance 1.0, but let's not get too far ahead of ourselves. We close out the quarter with an all-time high here in the NASDAQ. We close out the quarter with, relatively speaking, new highs here in the S&P 500. Not quite all-time highs in the ES U5 contract, but nevertheless, bonds are trading a little bit weaker in terms of yields today. Prices are higher. We ultimately see gold have a fairly decent session, closing up closer to 1%. Natural gas gets smoked. The dollar is off a bit here versus its counterparts following those yields. I suppose that's normal. Dylan, in the green room prior to starting, you were mentioning that it's been a few stressful weeks, but volatility is low and stocks are at all-time high. You know, what do we have to be worried about?
Yeah, but you're not launching a European luxury brand on the side.
How do you know?
Well, I didn't see it in Paris last week.
Okay. All right.
I slept in 77 days. No, I'm kidding. My stress is not market related. The market is keeping me calm. The nice thing about that, if the market was behaving like a lunatic, then I'm not sure I would have made it through the whole situation. Thank God the stock market is indifferent. If anything, it is. Here's what I think. I think the dollar is where it is. I think that if you actually look at the stock market returns on a dollar adjusted basis, the stock market is nowhere. What's happening is you're seeing the entire country of America marked down substantially, and the stock market returns are an illusion. It's a rising index inside of a shrinking currency. Thanks for nothing. How about that?
That's one way to.
Dollar has certainly been shellacked since the beginning of the year. Not to be
bitter, but I mean, when the dollar's in as much as it is, what's a dollar adjusted return on the index? Probably nothing. Basically, we're trading in our currency for the illusion of prosperity. And I think it's an absurdity and an outrage and an indignity, and I don't like it.
You did mention, though, at the end of last call there that you were talking with a banker last week who said that were it not for Trump, the markets would be trading higher than where they are now. How much of that is a guiding principle, you think, for how markets have behaved in recent weeks? We have his one big beautiful bill. We have all this tariff talk in recent days. Are we still just checked out to lunch about what's coming out of D.C.?
I don't know. I mean, on the one hand, there's the whole thing where Trump never does what he says, so you can just got to discount it. But on the other hand, a piece of legislation like the one that's flying around is more than Donald Trump, and that something's going to get past what it looks like.
Here's the amazing thing: stocks are up since the beginning of the year. ES futures up 5.65%. The dollar is down 9.5%. So I'm just taking an active continuous contract view. So, expect a little fuzz around that 5.6, 5.7 number. But the dollar is down more than S&P 500 futures are up so far for the year.
Yeah, which means if you're a foreign investor, right, you're let's say I'm in Europe or the UK, I decide that I want to get long the S&P 500 at the start of the year. So I have to take my British pounds, my euros, I convert them into US dollars. I'm now buying the dollar-denominated S&P 500. So the S&P 500's up 5% this year so far. I now want to, at the halfway mark, convert my dollar-denominated S&P 500 back into my home currency. And so I take my 5.6% gain and I convert it back into the euro. And now the euro is 11% more expensive. And so net accounting for exchange rate movements, I've lost money as a foreign investor holding U.S. equities in the first half of the year.
It's also how I've made money this year. Is my sins shorting the stock market have been overwhelmed by being short the dollar as well, and that one's moved more.
But that's interesting. So if you're obviously your dollar short's paid. Obviously.
Yes. Very much so.
Your equity short has not paid. Obviously.
Not consistently. I mean, it paid
And
from
so if you
February to
net-
April and then
yeah.
not.
Sure, but if you net your equity losses against your dollar gains, how does it net out, plus or minus?
I'm up. I'm up about
Is it- and you're
11% on the year.
And is the position sizing similar in both cases? In other words, is the
Yes.
dollar down more than the equities are up?
Mm-hmm.
Yes.
So I rest my case. What are we doing here? The whole thing's in contraction. This is a joke. It's an illusion. It's smoke and mirrors.
Maybe smoke and mirrors that are possible. You know, you mentioned that this thing potentially is getting overcooked here. We are more than 3% above our 1-month moving average in the S&P 500 right now, which is an important consideration. That has been consistent with tops having been carved out, at least in the short term. If not a top, a brief pause in the rally for things to settle down. You could make the argument that we are getting long in the tooth. It's a 10.9 IVR. But, I think it's a good time to also check in on like what's worked, what hasn't worked. Dylan, I think it was obvious now in hindsight that the call for looking for markets just to kind of squeeze higher into the end of the quarter, people chasing the market rally from mid-May onward, that was a good one. What was also a good one that you weren't here for last week, which I'm curious about your take on all of this, because the first thing I thought of when I saw the U.S. was bombing Iran was, I wonder what Dylan's going to do with oil here.
We didn't have it. I mean, that's the best one of all time. Look at that thing. Oh my God. That was unbelievable. It's the only thing that's worked for me.
Almost 12% last week.
If it wasn't for that oil trade, I'd be in the streets.
Okay. The European luxury brand collapses because you don't get.
Listen, that's a cost. There's no revenue there yet, pal. That's overhead. My equity trading is useless. The oil's the only thing I got a handle on.
Okay, but I want to go through that a little bit because we did miss you last week and the week prior when this all started kicking off in the middle of June.
I was here the week prior.
Yeah, well, I asked you, should we short oil yet? And you said, no, wait a few days. And that was on June 12th. And we get through this for a few days. And even going into that weekend, you said it's almost time. So when you're thinking about shorting it, you had to ride out that Sunday open.
Right. But when you saw the open on Monday, when nothing happened, I was at the event with Sosnoff here in Milan, and we were expecting lock limit 50 ways, war, all the things, and nothing.
Has your theory of geopolitics survived another episode? Is this something that you will forever go back to the well to?
I would say at the highest level that this is the biggest test in the history of my theory. I mean, this is active, direct military intervention by American B-2s in Iran. I mean, that's as hot as it gets, and still nothing. Unbelievable.
Elliot, should we continue to,
I'm not complaining.
No, of course not. Right. We're the kind of people who ride trade ideas into the ground until they stop working. And
I'm not even complaining. I'm glad for the people. Thank God. I thought that thing was going to forget. It's good as a trade, but also the reason the trade works is the war never happens. Thank God.
Well, you always got to bet against World War III, right? So
that's right. The fundamental premise.
Ilya, in the second half of the year, if we have geopolitical episodes like we have seen here in recent weeks, are we going to continue to do the WWRD? What would Radigan do? Approach to oil and wait for a few days and then fade it?
I mean, it certainly seems like that's the thing to do. It's just very important to watch the price action because obviously the markets did react to this. You do get to a point where the markets go, okay, well, fool me once, shame on you, fool me twice. The point is you can't fool me again. This was not that. Obviously, the market ran up and ran up hard. I was short oil under 64, then we broke that range, thankfully, before the real holy moly kicked off. And so I was able to get out just on the price action alone. And then you and I sold at the beginning of last week. We were just talking about this on Futures Power Hour earlier today. A week ago from today, you and I both got short. Both short oil, short vol in oil. And it worked.
Mine was short vol because I went
splendidly.
directionally neutral with the short iron condor and closed out existing short deltas. Yeah, Dylan,
I went short vol. I went short directionally. I mean, I was selling calls.
It worked out well.
Yeah, it did.
Yeah, Dylan, I think this is one of the ideas that has worked out. We've been riding this train, and we talk about the compression cycle of how when volatility creeps up into these markets, the S&P has had a shorter and shorter window of attention. April 24, really, you can actually go back to like October 23, but that takes a few weeks to work out, and you get to April 24, it's about a month from the market to go from low, from high to low to back to the highs. And then October 24, it's about 6 days. And when this pops off in June, it's about a day for stocks to recover where they were. But oil, it takes 3 to 5 days for this to wash through the system before it seems like it's appropriate to begin laying in those short call exposure. I think in the second half of the year, given what we've heard from, if we believe the U.S., Israeli, Iranian officials, it's all propaganda to a certain extent. But if you believe what's going on in that realm, you can't say that we're not going to bomb them again. And so if we find ourselves going through the same motions, right? What have we seen in recent months? Diego Garcia, the island in the Indian Ocean, not for the tariff reasons, but for the fact that it's a military base where we keep a bunch of B-2 bombers and long-range military assets. When we see these carrier strike groups moving into the region and oil vol is starting to puff up, just don't try to fade it right away. I think that's a lesson we've learned. You have to take it seriously, let it run its course. And then, dare I say, it also helps to watch some of the foreign news. Dylan, we were poking fun at the Ayatollah last week, who still has yet to respond to any of our direct messages. Oh, and I would be heartened to let you know, Dylan, as you were not here last week, several people have actually, in fact, now reached out to share the fact that they've been DMing the Ayatollah as well. Team America.
Really?
Yeah, it's nice. Yeah, solidarity here for what we're trying to accomplish. But what we see through all of this is ultimately, like last week on Iranian State TV, they were showing up pictures of the Statue of Liberty being demolished. And then they did a reenactment of all these Lego pieces attacking each other to say that the war was won. And like when you see that the Iranian state television declares victory over something, it means that they're trying to end whatever's happening. So you get that, you get the collapse in oil vol. Keep it in your pocket for next time we see geopolitics go nuts. Dylan, I'm curious as we think about the first half of the year as well. We've had this whole craziness with rates, with Trump talking about replacing Powell, with this, with that, the other thing. As we make our way into the second half of the year, what are you worried about most? What do you care about most?
Dollar.
Is that still the U.S. dollar?
I mean, obviously, it's supposed to be the dominant currency on the earth, and it's not behaving like it because it's been attacked. And so you're in this sort of dollar attack situation. I think that the biggest risk is a weaker dollar for the rest of the year. I don't know if it's the biggest risk, but I think it's the biggest secular shift in years. Because I think AI is off to the races beautifully. I think transportation technology is about to go full crazy. I think it's really going to be big. And I think we haven't even really kicked in on so I would say the thing I'm most optimistic for is transportation technology. The thing I'm most worried about is the dollar. And the thing that I'm most perplexed about is the market's relationship with the Trump tax policy.
Ilya, what's your take here on the risk? Is it the dollar the biggest risk for the second half of the year, or are we still waiting on what the Fed's going to do? Just draw a number out of the box in terms of concerns out of DC. Is it DC or is it something else?
I think you're getting to a place where economic growth has to start to matter because you're getting through all manner of headlines. You're shrugging them off for the most part. The weaker dollar is certainly a thing, but it's not weakening in any kind of way that would make you think, oh no, this is the collapse of civilization here or anything of the sort. We flirted with that idea, certainly, in the sort of Liberation Day shenanigans where the bonds were moving like bonds don't move. We can see it on the screen here. The dollar was moving in a untoward way, obviously, against that backdrop. It's not surprising, really, that the dollar is down. It might be a little overcooked here at this point. We might have a little bit of a correction. I'm still bearish, but I'm not actually exposed on that side anymore. Now I'm slightly long dollars against the British pound, just because that one doesn't seem to want to move like all the others. The dollar is down again, not negligibly, let's say, against the euro, against the franc, against the Aussie, against the Kiwi, against the Canadian dollar. You go down the list, but the British pound for some reason can't rally. So I'm short it because it seems to be weak need here for whatever reason. I think the dollar is a little overcooked on the downside. We'll see. But for me, the biggest thing is forget everything else. The bond market is telling you that rates need to be lower. Break-even rates, that is inflation expectations in the bond market, are down. The Fed funds futures structure, as a consequence of that, is telling you the Fed is lining up for 60 basis points in cuts this year and next, which is a lot more than what the Fed itself is saying. As of today, the markets are at 125 basis points in cuts between now and the end of next year. And lest you think, and we mentioned this on Futures Power Hour, lest you think this is all this chatter around we're going to have a new Fed chair in the second half of next year, and that's why, no. Because the cuts are front loaded to the back end of this year and the first half of next year, with Powell still there. So the market is very clearly saying the Fed is going to have to cut more than the Fed is saying by a good bit, by 50 basis points, more than what the SEP said just 2 weeks ago. So this is a big disparity. This is the market saying you have a growth scare on your hands and you're asleep at the wheel. You won't cut, whereas you should. And maybe you don't cut for political reasons because the president is goading you and you want to look like you're still in charge, which is the right thing to do. Tactically, perhaps, the Fed's credibility is incredibly important to everything it does. The president might consider that the more he goads Powell, the less likely it is that he's going to get what he wants, which is rate cuts. But at the same time, the market is screaming at the Fed that, in fact, cutting rates is the thing to be doing. And somehow this disparity is going to resolve itself. So I'm watching economic data very closely. Obviously, we have ISMs this week. We have NFP this week. There's a lot of big data. And Powell was speaking at the ECB forum in Sintra. Now, is he going to say anything materially different than we heard in the testimony last week and from the FOMC press conference 2 weeks ago? No. But what a contrast it would be if the data tells him you should have been cutting and you better be going in July.
Second half of the year, rate cut odds, they are bumping up a little bit, but it's really not for this year where the action's at. It's for the end of next year. And this is the third highest close in year-end 2026 rate cut odds that we've seen since the beginning of October of last year, right? Rate cut odds have been higher intraday, but this is the third highest close that we've seen in 2025 for year-end 2026 rate cut odds. So the market's starting to get a little bit worried about something.
Just for fun, by the way, take a look at SR3M6 so that you can see this is not a Powell thing. This is the first half of the year here through June of next year. Mm-hmm. This is not linked to changing a Fed chair mid next year. This is not the market saying, oh, we'll get a Kevin Warsh or a David Malpass in there by the second half of the year, and then the cutting comes. Nope.
No, the market's beginning to say that the Fed is going to act organically prior to Powell leaving his position. Yes. But Dylan, I can't help but think this is just a ton of noise. Trump's obviously being very vocal about this. He's been tweeting about it. He sent him a letter today, an autographed picture to Powell. Do we care, knowing that Trump's actually not going to fire Powell? Should we just ignore this and stop talking about it?
Obviously.
Oh.
Yes. I mean, the only thing that Trump may actually do is this piece of legislation. because he's got buy-in from the Congress and because everybody has the interest in the wacky ass tax cuts. But some of these other things from the executive side, I think that there's a lot of bark and not a lot of bite. When it comes to tax cuts, there's a lot of consistency out there.
What's the consistency?
The Republican Party, when they come into power, cuts taxes for the rich.
Do you have a particular feeling on this tax bill that's making its way through DC right now?
I mean, I don't think it is in the interest of conservative financial management. How about that? I mean, I think that the idea that Republicans are conservative as they tee up $3 trillion deficits.
Well, in fairness, we're cutting taxes for coal and increasing taxes on solar and wind. So if you dislike clean water and clean air, this bill's got something for you.
I agree with that.
I don't think, does the market care about this, Ilya? This is why this whole tariff talk, we focused on Futures Power Hour today about this all being noise. Where's the signal? Because are we really going to get the tariffs extended as Trump's tax bill is about to be signed into law? Will the administration really risk the messaging that the stock market's crashing right as the tax bill signed? Because it's so easy to say that the market's crashing because of the tax bill. And if they go, no, it's not the tax bill, it's the market reacting to the tariffs, then you go, okay, so the tariffs are bad? And they're like, no. It's not exactly a story to sell politically, right? I'm taking the under on July getting off to a rocky start because I just don't think that they're going to do much of anything that, at least on the tariff front, to upset the apple cart right now. While you have, look at industrials, XLI, industrials sitting at a fresh all-time closing high here. Same thing for XLF financials. You can make the case if we go over to something like XLK, technology, a new closing high. Banks, industrials, tech. That is still early cycle kind of bull market behavior, which sounds so ridiculous as we close at all-time highs here today. But the breadth is good, Ilya. Why can't this thing run for another few weeks before it comes crashing all down?
I mean, it can. Nothing says that it can't necessarily. But I would take a step back and go, why do we assume that the president cares about any kind of electoral calculus, considering in any kind of a realistic sense?
Because of what he said yesterday. Did you see what he tweeted out yesterday?
Sure. Realistic sense.
He said, Trump said, for all cost-cutting Republicans, of which I am one, remember, you still have to get reelected. Which kind of like portends the political character, which is if you pass a really aggressive cost-cutting bill, which a lot of Republicans want, and Trump says he wants, but not doing, then you have to go back now in district in late 25 and early 26, running up into the 2026 midterms, telling your constituents that you just closed down the hospitals.
But this is exactly it. Why does the president care? The legislature cares. But why does the president care? And
Trump does not want to have a back half of his second term with a Democratic Congress investigating him, because we know that's what's going to deal. If Democrats take back the House,
so this goes to the tariff conversation.
Yeah.
Just last week, and Canada has off-ramped this, kudos to them, but just last week, in the midst of all of this, the president moved to blow up negotiations on trade with Canada. And he did it because of this this digital services tax that was going to go into effect. Now, Canada, of course, has scrapped it since. And now, apparently, we're back to negotiating with Canada. But my point here is the president is showing us, in his mind, he's going to do what he's doing. It's up to legislators to fall in line. So I'm not sure that we're necessarily not going to have anything happen with the July 9th deadline, or more importantly, I would think the August 12th deadline with China, because if the president doesn't like the vibe, he's going to do what he's going to do.
Dylan, it sounds like they're running it hot. It sounds like they're just going to keep spending the money. tax cuts for the wealthiest. It's going to help people who are the kind of people who gamble in the market, invest in the market, trade in the market, whatever you want to call their market behavior. We've seen the meme stock activity in years past, which I don't think you could say is tied to anything or anyone's fundamentals, right? There's no strategy there. It's simply just finding a shiny object and bidding it higher. I would consider that less trading or investing and more gambling for what it's worth. But if they're going to run it hot, why shouldn't we trade it hot? Why shouldn't we just be levered silly in things like Bitcoin and gold and anti-dollar assets?
We probably should. We probably should. I mean, the last time I went through this, I was wrong 10 ways because I was like, this is because I was criticizing a policy as opposed to accepting reality. And I think you're probably right.
I mean, the question is, running it hot would necessitate that it is hot. But the level of economic growth has slowed. We are already not at the place where we were at the second half of last year by any stretch. Right? Name an indicator. So
sure, but if we pass
running it hot would necessitate having a hot economy.
But if we increase deficits by like $300 billion a year, that government deficit becomes a private sector surplus. Right? Doesn't that help cushion the economy from a significant pullback with all this new spending going on?
We're going to have to see. Because it's not like we've had a major retrenchment in spending so far. This entire Doge idea has not cut any meaningful amount of government out.
Doge was never about cutting spending. It was a power grab. It was a power grab.
Well, so this is the thing. Why are we slower now? Is it because the government is less expansionary? No. So we're already running the part of the government that we were going to run as hot as we're running it. This monstrosity of a bill, it's long, it's big. Whatever you think about it, good or bad, its impact is spread out over a decade and some change. This isn't like all happening right instantly now. So the question is, okay, how much new demand do you add immediately to 2025 and 2026? And does that change the market's calculus on growth? Because the market is telling us the Fed's wrong, it should be cutting, and it's because the economy is slowing. So is that going to change the calculus for the next 18 months? I don't know.
Dylan, Bitcoin still feels like it's underloved here. I know it's...
I agree. I agree with that. And I hate Bitcoin, but I think that as a trading thing, it's probably a very good opportunity to make some money.
Ilya, forget the ticker here because I know you're not a big fan of crypto, but if you saw this in a textbook, would you think this is bullish or bearish?
I mean, time will tell. Because in pure technical terms, what this is either the rounding of a top or a continuation, flag, pennant, something or other. And you don't know. So far, you've had an attempt to break this would-be double top, and you failed. So upside break, failure, second upside break, failure. Now we're maybe making a lower high. Maybe at the last kind of gasp of this indecision before we get a really convincing break higher. With the dollar as weak as it is already, with gold looking kind of long in the tooth as a kind of proxy for anti-dollar sentiment, this might have a hard time getting off the ground. This might be toppier than it is. More toppy than it is a continuation pattern, but it is a textbook continuation pattern if it plays out that way. We just have to see.
Could you squint and maybe see what I'm seeing here, guys?
No, you can see the cup, you can see the handle, sure. The question is, do you get the confirmation? You need the breakout.
Well, this is, I guess, in this stage, right? Resume buying from the bottom into the right side of the cup. That represents this portion here, which means 7 stock once again tests its highs, 8 into another pullback, testing the highs into another pullback. This feels pretty darn textbook to me. Cup and handle. There's also the whole, maybe this is a left shoulder head, right shoulder. Maybe this is just simply a continuation. But I'm trying to slice this up a number of different ways right now for Bitcoin. And I just see a world in which we have this gigantic deficit in debt coming. It's a backdrop in which people are questioning the role of the dollar and maybe even the fiat system in the most considerable way, not just the US dollar, just fiat generally, for the first time since 1971, outside of the brief episode of the euro, right, and the Eurozone debt crisis. There really hasn't been a check or question about fiat's long-term viability. And the timing just feels right. The fact that this is so underloved, there's no volatility pumped into this. No one's out there posting videos of themselves on yachts in Miami again, or renting Lamborghinis and claiming it's their own car. Like, you don't see those videos anymore.
That might be for a good reason.
Yes, because no one's participating right now. Everyone got out back in January and they got their exit liquidity. And then the people who bought above 100K got bled out over a few months. And then the whales stepped back in again down near, 80K in Bitcoin. But I would think that we've talked about this in recent weeks about going something long in that 75 neighborhood. Dylan, I think the time is right now. And we could do something in the neighborhood of like a 20% probability of profit, risking $7,200 or $720 to make $92.80. Looking for a vol expansion, perhaps a breakout, maybe a tail wag the dog kind of thing, where because the market's breaking out, people are buying deeper out of the money calls, so it pushes up price. But assets like real estate, gold, silver, Bitcoin, I don't know. You talk about the dollar being down so bad in the first half of the year. What's the reason why it would stop falling at this point in time? I just don't know.
I can't find it.
Maybe chat can tell us. I just don't have the answer right now. And then Trump's comments this weekend about the Fed, not being able to lower rates, so he doesn't want the Treasury to issue any debt with maturities beyond 9 months. That could really hurt the dollar, Ilya. Mm-hmm. We're just going to deprive the world of greenbacks. Like, sure, but on an exchange rate basis, what is it going to do?
I don't think we have anything here that hasn't been thoroughly priced into the dollar for the past 6 months. I think I'm bearish, so I've been bearish. I think the question is what's going to make the dollar go down incrementally from where it is currently. That's the larger question. If you ask the euro, nothing. It's rallying. If you ask the Aussie, nothing. It's rallying. But if you ask the pound, unclear, because it isn't. And so from my perspective, you have to look at the price action here now. Because all of these larger narratives, it's not like they're new. So they're baked into various extent in various assets. And the question in my mind isn't why shouldn't the dollar be down? It is down. It's down a lot. The question is, why is it going to keep going down from here without a correction? And I think that's increasingly a more difficult argument to make. At least for now, at least tactically. I fully expect to be short dollars again this year, and in size. Your sound's gone.
Sorry, I was just looking at the CBOE's volatility report here as you're talking about all this. And, there's still perhaps a little bit more volatility to be squeezed out of these markets. This just popped up of interest, this particular slide here. We think about S&P 500 at the month implied volatility. It's not back to where it was prior to the February 21st growth scare starting up. The same thing can be said for the Russell and the NASDAQ. Maybe that's what we need to do, Elliot. We need a round trip on volatility. We need to kind of like wipe the slate clean. And then at that point, it becomes a new ballgame. Dylan, this is a holiday shortened week, though. Ilya talks of an environment where we're starting to see growth concerns percolate a little bit. And sure enough, we shared some stats and some charts today on Futures Power Hour showing how both hard dollar and cents data is starting to deteriorate alongside softer feelings, sentiment-based data. Do you have any strong feelings for the importance of this week's non-farm payrolls report? Could it creep up us on here and scare everyone that the Fed is behind the 8 ball? Or does economic data not matter in this brand new, brave world we find ourselves in?
No, it matters. I mean, if anything, I always have felt that the single most important number that will exist, does exist, whatever is that number. So it always matters. There's never a situation where the jobs number doesn't matter. There's situations where the jobs number matters less because it's so pinned to expectations that it's baked in. But the thing with the jobs number is, of all the numbers out there, it is the one that is capable of squirreling out both in one direction or the other. So the forecasting with that number has always struck me as less reliable than certain things. So I don't know how dialed in this week it is this month, but I don't think you can ever dismiss it, and I don't think the holiday shortening is relevant to it. And I think that it's really the relative strength of the number, or at least the relative consistency of the number compared to expectations, that is the foundation upon which all of this fruit birdery goes on. The jobs number it's jobs and inflation are the two things that can call the whole thing to a halt in a hurry.
Ilya, you and I touched on this briefly, earlier, swallowing my tongue there. We see that 10-year yield is down below 4.25% now.
Mm-hmm.
Are we of the mindset, where does the jobs number leave the greatest impact in the coming days? I suppose I should be asking. Is it stocks? Is it bonds? Is it the dollar? It feels like rates, big picture. I mean, you can kind of see here, we're basically in the midst of a multi-year trading range right now for 10-year yield. I mean, do we care? What cares about this jobs report Friday?
I think we have to care. I think the disparity between what the market thinks is going to happen and what the Fed thinks is going to happen, I think, demands that we care. Because here is a piece of data that can actually start to tell you either this side is right or that side is right. The Fed is worried clearly that they're going to let inflation out of the bag because these tariff impacts are coming. And obviously the 90-day delays on their implementation has obfuscated what the impact is going to be. So the White House is raging, but it's their doing that the Fed hasn't had the clarity that they need to make a call this way or that, because first they decide to roll out these tariffs that muddy the water, and then they decide to delay them for 90 days and muddy the water further. We're still not to the end of that delay period, and they're wondering why the Fed is wringing its hands and waiting. So the situation here, I think, to Dylan's point, is very much that of a fruit birding kind of approach to policy. So fruit birdery, as it were, which I think is a term we need to coin now and for all time.
Consider it properly minted. I mean, it's obviously fruit bird, and there's a lot of fruit birding going on.
That's right. That's right. And so, of course, you have to care about this data because the markets are telling you one thing. The Fed is telling you something else completely. Either the Fed is right and the markets are wrong. That's happened before. Or the Fed is going to get cajoled and pulled along. That's happened before. We just saw it last year. So let's see. But if you asked me what would be the more impactful thing, I would think it's actually numbers that are weak. If you get a miss, as you've tended to see on U.S. economic data over the past month relative to forecasts, if that's what this ends up being, then the markets are right. The Fed is off sides. And then you get an impact in the bonds, almost assuredly. You probably get an impact in the dollar. You probably get an impact in gold. The question is probably the most interesting in stocks because they are the most extreme and the most seemingly complacent relative to what's on the board. Like, people have expected a lot of Fed rate cuts. Dollar is down, gold is up, bonds are starting to come off the lows. All of that makes sense in context. Stocks are at the highs for the year, if you look at the continuous contracts. And then you go, okay, or frankly, even the September ones, doesn't matter. The S&P ESU 5 is at its high for the year. So what happens if this is built on a premise of the Fed is going to let the recession happen and be late? Does that still make sense? Not to me. But
well, the Fed's always late.
Well, no, there's late, and then there's normal, which is a reactive central bank, late. And then there's late, right? The central bank is reactive, not proactive. That's every central bank. That's normal. So are they late or are they just reactive? And I think the markets are telling you they're late. That's why they have 125 basis points and the Fed has 75.
Do you think we're going to is that one surprise that we're going to have after the end of the summer? We're going to have a 50 basis point cut in September. The Fed's going to be so late they have to do what they did last year. Is that the world we're going in?
The question is, will the markets react the same? Last year, they said, oh, ho, 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 ho. We weren't saying all that. You did too much. When the Fed did 50 and said there's 50 more and 2 meetings, you do the math. So when the president, by the way, says that the Fed isn't cutting, they did cut by 100 basis points last year. So there is that. But nevertheless, they cut a lot. And when they did make a move in September, the market said, that's too dovish. Hold on a second. And the markets adjusted immediately. To what? To higher yields and a stronger dollar. So this pause that we're watching right now, ostensibly, it fully got baked in last year. Because the market said, you're not going to do as much as you say, you're going to have to walk this back. But now the pendulum has swung the other way. Now the markets are more dovish than the Fed again. We saw this movie last year. Between mid-April and mid-September, when we had this identical setup, the dollar got shellacked, bonds rallied. Now, obviously, the dollar has already gotten shellacked, so maybe that move doesn't have much more in terms of legs, but the bonds are just getting started. And stocks look way off sides.
Dylan, I'm just so intrigued by that comment you said earlier. It's still rattling around my brain that if it weren't for Trump, the market would be higher, which, yeah, true, right? I've seen this really silly thing, and this just really grinds my gears of people saying like, oh, Trump was right when he said in April that, it was over and it was a good time to buy stocks. Yeah. Because the guy who caused all the damage told us that he was done causing the damage. He didn't make some solid prediction about how this was all going to work out. He said everyone's going to be groveling for trade deals. We have one verbal agreement signed with a country that we have a surplus. Right? All of this has stopped. Like, the market's back to where it is because Trump backed off of all of his things. It's not because he implemented a new policy. He pulled the gun away from our head. And we're cheering that look what he did. Look at the markets now. The market's doing this in spite of him, not because of him. That said, there are some things that could make the market go higher, of course, that he's doing. Maybe we'll see what the final bill looks like, because it seems awfully generous if you are someone who plays with financial assets for a living, right? What does it do for the long term, though? We'll have to see. Guys, let's end this session with our biggest mistakes from the first half of the year. What were your worst trades? What did you not do correct? What do you wish you did differently? I suppose I'll start while you guys think about this, because I've thought about this a little bit. I have repeatedly said that when the leader of the world's economy, who has his hands on the levers of the economy, says something like it's a good time to buy, you should not think about anything else other than buy. And we know that because that's what happened in March 2009. 3 days after the S&P 500 bottom on March 6th, President Obama came out and he said, now's a pretty good time to buy stocks. And sure enough, the economic policies that come into place are all the things that inflate stock prices. President Trump said that in the first week of April. And while I wasn't long the stock market in any considerable form or fashion while we had that huge sell-off, I was pretty diligent about avoiding it, which I'm content with. I did not shut up and buy stocks to the degree that I should have. It took me a few weeks to come around to the idea that, like, really, okay, this is over and done and we need not worry. So I've been able to participate in the chase for the past 6 weeks or so. But I did not follow my own rule. Maybe that's for bias reasons. Maybe it's because whatever, right? But I have a rule that I always typically, and we've talked about this for years, Ilya, and I've said it here on air. When someone with their hands on the economic lever says, right, when Powell said it back in April 2020, guys, I'm going to throw the kitchen sink at this, don't worry. It was so easy for me, and this is why I'm so pissed about this. I've talked for so long about how it was so easy for me to just shut up and buy stocks in April 20, because psychologically, I was on paternity leave. I didn't have any active trading positions on while the market collapsed. So I get back to work and, like, here's the Fed chair telling us to shut up and buy stocks. Easy peasy. No psychological damage. And now I see that I really, that did wear on me here this time around. And so I need to do a better job being diligent about letting my own biases get in the way and letting, like, the shell shock not set in for such a long period of time. So I'm glad that I didn't lose money during the downturn to any substantial degree. I wish I was a little bit more aggressive coming out of it because I broke my own rule. And I got to follow my own rules because they usually are a rule for a reason. And they're not like guidelines and exceptions. They're rules. When people that control the money say buy, you got to buy. Ilya, what was your biggest mistake in the first half of this year?
I mean, I was having a really great time being short stocks and even being long them off the bottom, but clearly I got back short way too early. And thankfully I did it as I've been doing, with lots of duration, 60 days rather than 45, in a risk-defined way that kept the losses very contained. But nevertheless, and it's a similar story to you, is I was looking for it a little too hard. I was looking for the turn too hard and not giving myself the kind of confirmation that I would normally allow myself to get. If you look at the S&P chart without knowing it's the S&P and without wanting to be short the S&P, the technical signals are not strong enough to get a short as quickly on the way back up as I did. This now makes sense where we are now. Not because there's a strong technical signal, but just because the risk reward is so amazing here. Vol is dirt cheap. You're at the high. It's the end of the quarter. Roll the dice. The risk reward's amazing. So that's one thing. But on the way up off the lows, there wasn't as good of a technical signal to get short as I would have normally demanded of myself, and I got in way too early. And thankfully, I didn't add a bunch of positions and attempt to fight the market. I just put it on, let it expire worthless, and that was that. But that significantly ate into my equities performance, which up until, let's call it mid-April going into May, was riding the waves pretty well.
Dylan, what's your biggest mistake from the first half of the year?
Anything related to stocks?
Anything?
Everything and anything related to stocks has been, I mean, not everything, but might as well be everything. I just really didn't think that the market would look past the Trumpian trumpery. And it did. And so that was not anywhere near that rally coming out of April. And I also didn't think that the dollar would do so poorly. So between the dollar and equities, I've got to be quite irritated. If it wasn't for the oil flippity dip, I'd have real problems. But fortunately, the short World War III thing keeps me in business.
Short World War III is always the right side to take because, like Pascal's wager, you just work out the math. If you're wrong about there's no World War III, your counterparties are vaporized in the nuclear war, so you don't have to worry about paying them or topping off your margin. That's kind of a joke, but it's really not a joke. And that goes back to the 1960s. Before we end out the show,
as much of a joke as you might like.
No, it's no, that's like a legitimate trading strategy of mine. When World War III pops up, I fade it. Here is from the Congressional Budget Office and the Committee for a Responsible Federal Budget what happens if the Trump tax law goes into effect. One of the reasons why I say we're going to run it hot. The current law as written has a little bit of a fiscal cliff here, where at the end of 2025, the Trump tax cuts from 2017 and the TCJA would become permanent. And that's why you see deficits fall, because there's an automatic tax hike that goes into effect. Okay, if the TCJA is not made permanent through Trump's One Big Beautiful Bill Act, or the OBA. Okay. The Senate's version of the bill, as written right now, increases deficits from where they are about 6.4% to, well, gearing up towards 7 over the next decade. The current law as written is 6.1%. If the Senate bill is made permanent, deficits go up to 7.8% over the next decade. So when I say run it hot, right, we're talking about increasing deficits as a percent of GDP net over the next 10 years. And it's not like there's any significant pullback whatsoever to get the federal budget and deficit and debt under control. So if you think that government spending is the problem, this probably doesn't work for you. If you think government spending is a problem, but not for assets that tend to inflate when government spending goes up, then maybe if you're a Bitcoin, gold, stocks, real estate kind of person, this looks just delightful. But we'll have much more to cover because overtime is out of time for today and this month and this quarter. But we'll be back tomorrow with the start of the new month, the new quarter, the second half of the year. Same time, same place, as always, 4 p.m. Eastern, 3 Central here on Tasty Live. So for Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. Good luck trading. After a brief break, more Tasty Live. Ilya's back with macro money. See you there.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today. You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
What's something that traders tend to obsess over that you think doesn't really matter?
That's a hard one. I think, of course, it's different for everyone, different psychological mindsets. For me, it's I found myself getting ahead of myself, trying to manage too many trades at one time, and also trying to focus on your narrative, your strategy, and holding to your cards when things can turn against you. So kind of your conviction.
Honestly, it would have to be news. I would say, and this has been one of the things that I've sort of fine-tuned myself since I've been at Tasty. News is something that we all kind of look and pay attention to, but it doesn't always have to drive your opinions about trading. And I think the less that we allow that to happen, I think the more clear-headed we are, and then we just end up using mechanics.
People get a little too nervous about it.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Well, we are on the last day of this second quarter, and what a quarter it has been. Stock markets finishing the day with a little bit of further push, ending up at the very top of the starting line for the year here for the S&P 500. A quiet day, nevertheless. And a lot of questions swirling about what comes next as the second half of the year gets underway. We're going to look at the macro headwinds and maybe tailwinds too that are on the menu for this week. As we always do, this is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we'll do is we'll take a look, as we usually start, with how the markets performed last week. You'll notice once you look at the breakdown there, it was a pretty one-sided sort of a situation. But once we get that done here, we'll take a look at what the markets actually did and why they did it. And that's not the table we're looking for. This is the major markets as they behaved last week. And not surprisingly here, sharp decline in yields, bringing a sharp rise in stocks. And certainly the 11.3% drop in crude oil does not hurt. That's sort of the main takeaway here. Not surprisingly, of course, that decline, that massive decline in crude oil, speaking to the situation in the Middle East and how that has worked out here. Obviously, there was a very legitimate concern that there was a significant sort of geopolitical disruption in the region as the U.S. moved to involve itself directly in the conflict between Israel and Iran. But since then, we've obviously taken a step back into a more contained sort of setting. And not surprisingly, once it became clear that both Tehran and Washington were looking to walk this thing down into a less acrimonious, or at least less explosive sort of setting, that's given us a significant come down on crude as worries about supply disruption there go away. Gold comes down 2.9%. The dollar weakens. We can see it here down against both the euro and the yen. We have a decline in yields that seems to suggest that maybe the Fed is going to have to do more easing despite their protestations. We'll get on that momentarily here. But stocks ultimately find reasons to like the canceling of a broader war in the Middle East and a pullback in borrowing costs, not surprisingly. And so the S&P and the NASDAQ here on the upside with formidable gains last week, very spirited as a matter of fact. And we start this week in the same sort of tone. Shares higher, yields continuing to fall, crude oil now just idling, but gold finding a little bit of support, and the dollar kind of a hodgepodge, down mostly, but unable to make gains against the pound for what it's worth. And so it is with this backdrop that we begin this week, where despite shortened price action because of the U.S. Independence Day holiday, there is plenty of macro on the calendar and lots of reasons to be paying attention. We start in the euro area with Eurozone CPI numbers. They're expected to give us a slight wiggle higher to 2% from 1.9% in the prior month. And this perhaps is most interesting in terms of what it might mean for the ECB next year, because what it means for the ECB this year seems pretty well established. But if we look at the policy breakdown here, we can see the ECB on track to do one more rate cut this year, 27 basis points baked in here through the end of this year. But if we look at what's going on for next year, there are no more cuts on the menu. In fact, we're actually quietly inching a little bit into positive territory. And although it's only 5 basis points so far, it's not quite the rate hike scenario where it looked like maybe we were 50-50 on a rate hike back in March, when it looked like there was all this emphasis on the defense spending that the Eurozone is going to do next year to beef up NATO. We now have a little bit of a cool down here, but we're starting to see this perk up again. And indeed, looking at break-even rates in the euro area, these are German stand-in for region-wide numbers. And we can see here, although we're not where this spike occurred in March, this was all those spending plans being front and center, and things have cooled off since, we have sort of started to anchor on inflation expectations, and that's suggesting that maybe we're going to get to a place where the euro is better supported by a positive rates story. Now, what's maybe most interesting about this is we already got the German numbers earlier today, They tend to be a good precursor for region-wide CPI, and those numbers were a little bit weaker than expected. And that has certainly not prevented the euro from rallying up a storm. In today's session, the euro is up a pretty substantial 0.6%, putting it at the highest level since September 2021. So we're essentially talking about a 4-year high. So perhaps the market isn't prepared to beat down the euro just because immediate inflation is a bit on the low side. And that, interestingly, gives us some good backing. The German numbers came out with a 2% inflation rate for June versus 2.2 expected. The core coming out, or the harmonized version rather, coming out at 2 as well. So looking at the situation here relative to expectations for the overall, maybe this then comes out a little bit on the soft side, maybe steady at 1.9, maybe even a little bit softer. But the real question is, does this ultimately hold the euro back, or does it even still care? And maybe the answer is no. In any case, looking at the makeup of inflation, the most recent numbers have food near the top of the list, as well as energy. And that perhaps is one reason why the ECB is maybe not paying a terrible amount of attention to these numbers, because if in fact you started to shave off these readings, then you're left with sub-target inflation. But of course, the ECB doesn't have much agency over global food and energy. And so maybe they're content to just stay on autopilot with what they're already intending, then let next year's fiscal dynamics drive what they do next. Then, of course, the spotlight shifts back to the US and the Fed. And here, things are very interesting indeed, because, of course, we've opened up quite the disparity in the market's policy expectations and that of the Fed. Just 2 weeks ago, the Fed gave us an updated set of economic projections, the latest summary of economic projections released with the FOMC announcement. All of that followed last week by 2 long days of torturous testimony from Fed Chair Powell, first in the House of Representatives, then in the Senate. And the message in all of this communication was the Fed is in no hurry to do much of anything, because with an inflation rate at 2.4% and a jobless rate at 4.2%, there seems no hurry to try to guess what tariffs are going to do. The Fed's expectations are that tariffs historically are a good guide for tariffs now, and tariffs historically, the Fed would argue, and evidence would support them, are bad for growth and tend to lead inflation higher. And it's the leading of inflation higher that the Fed is most concerned about, having so painstakingly been fighting inflation since 2021, 2022. So what the Fed is saying here is, look, we're not going to cut because the economy isn't screaming for us to be fighting inflation or fighting to boost employment. We know that the tariffs tend to have these influences. We're going to see what happens, because, of course, the impact of the tariffs has been muted by the White House's decision to pause them for 90 days so that we don't really have clarity. It already takes time for things to work their way into the overall economy. It's not instant by any stretch, but when you extrapolate by 90 days the actual impact of the policy, well, then you're going to have to wait longer. And the Fed would argue that they have all the time in the world based on how the economy is performing currently. The markets, on the other hand, are not clearly seeing things the same way. Whereas the Fed baked out 75 basis points between this year and the end of next, the markets are at almost 125, which means they are 50 basis points more dovish, give or take, than Fed officials. And not surprisingly, the question then becomes, well, why? Why is it that the markets think the Fed is going to be more dovish than the Fed is saying this year? 61 basis points is clearly greater than 50, which is what the Fed has, and is about 50-50 now, 11 basis points on a third rate cut this year. For next year, the Fed is at 25 basis points and the markets are at 63, which means, again, 2 cuts are priced in and we're about 50-50 on a third. So this is not about, as some have posited, the idea that the president wants to have a new Fed chair in the second half of next year. Powell's term expires in May. So perhaps, or at least the theory would go, the president is going to nominate someone else for that role. And that someone is going to be very dovish and they're going to be cutting rates a bunch. Well, as cute as that is, if we look at the breakdown in Fed funds futures, we can see that actually rate cuts are front-loaded to the first half of next year, at least for next year's outlook. 40 basis points up front in the first 6 months of the year, and the remainder thereafter. So the markets are seemingly saying that there's some kind of an economic necessity for easing that the Fed is not appreciating. We can see that show up in the economic data. So looking at the outlook on data surprises, we can see this index from Citigroup that measures the way that data performs relative to forecasts. It is the most downbeat for the U.S. Now, we did have this errant spike last week around a very buoyant durable goods orders number, but that, of course, on further reflection, seems to be mostly smoke and mirrors and front-running of tariffs rather than actual demand. So at this point, it's difficult to make much hay of it. In any case, though, we can see that before that aberration, there is a downward slope to global economic data performance, which obviously isn't coming from emerging markets where things are holding steady, and is instead coming from the G10. And in the G10, it isn't coming from the Eurozone where things actually look pretty well anchored. So if it's coming from the G10 and not from Europe, where is it coming from? Well, obviously, here. So we can see that the U.S. economy, at least in terms of economic data performance relative to forecasts, is now a drag on global performance as a whole. We can likewise look at the GDP Now forecasting from the Atlanta Fed, and there are a couple things that stand out here. The first one is that the range on second quarter GDP growth expectations is shockingly wide, from 0 to almost 4%. So nobody really knows where growth is going. But more importantly, if we look at the trajectory for this GDP Now forecast, we can see that since late May, the data going into the bucket has been negative. The way that this nowcast works, and there's a little explanation right here, what we have is a model that takes in incoming economic data and is sometimes updated as often as every day. So what you have here then is a sort of running tally on the tone of the data going in the model. And you can see that the tone is increasingly negative over the past month, which of course lines up with what you see right here. Then, on top of all of this, there is of course the bond market, which, not surprisingly given where Fed funds futures are, is telling you that the Fed is wrong to feel ambiguous, that the market is in fact not ambiguous at all, that there isn't a concern about inflation expectations, and that the concern really ought to be about growth. We saw this in the beginning of the year, where the implementation of tariffs left the market so worried and so thoroughly concerned about the cyclical implications once business and consumer confidence surveys began to show that the tariff rollout was impacting them in a very negative way, that inflation expectations and stocks were falling in tandem. Stocks have obviously rebounded. Here we are back to the starting line on the S&P 500, as we mentioned earlier. But inflation expectations have not. The bond market still thinks inflation expectations are going to be just about right-sized relative to where they were near the lows in April. That obviously tells you that the market envisions some kind of disinflationary weakness in the business cycle. And of course, with all of these pieces put together, the weight of economic data this week ought to be relatively significant. First up, the ISM economic surveys. The manufacturing numbers due first. They're expected to show that the sector continues to contract, as ever these are done in terms like any other diffusion index PMIs, just like the S&P global numbers, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So the implications here are that we're going to have a further contraction in manufacturing. In fact, this would be the fourth consecutive month of contraction for the U.S. manufacturing sector, but at a slightly slower rate than in May. So up from 48.5 to 48.8. For services, the expectation is that is going to hold basically steady. 50.5 is basically neither growth nor contraction by very much. It's modestly positive, so I suppose it's a little bit growthier than the alternative. But it's basically standstill after a reading of 49.9 in the prior month, which was the first reading below that 50 mark since December of 2022. So quite sharp there. And you were at sort of nominally, episodically as a one-off below 50 in April 2024, but of course that very quickly gave way to positive readings. There was another episodic one in June at 48.8, but again, that gave way very, very quickly. So the question then becomes, was May one of these strange one-offs, or are we looking at a more structural slowing of the U.S. service sector, which is, of course, where most growth lives? Given that U.S. economic data has tended to surprise on the downside, as we've just seen, and the overall tone of the incoming numbers, the implication would be that the risk here is for a downside surprise. But even if you don't get one, the upshot here, since services is a much bigger part of the economy than manufacturing, is that when you take these together and you kind of mentally construct a composite PMI index, you figure about 2/3 services, 1/3 manufacturing is how you'd weigh these. So you'd end up with an economy basically at 50, an economy at standstill. And then a little bit earlier than we would normally on a Thursday instead of a Friday, we get U.S. jobs data. Here the expectation is you're going to come down to 110,000 jobs created from 139 in the prior month. And the jobless rate seen ticking up to 4.3%. Again, not very high by historical standards, but certainly a move in the wrong direction. And again, the expectation is that the risk in these numbers is of a downside surprise, and that the market is already screaming at the Fed about that risk, putting the Fed off sides and suggesting that the central bank is going to have to do a lot more easing than anticipated. If, in fact, these numbers end up endorsing the market view of policy, well, then we probably start to look higher for bonds. We start to wonder what the dollar is going to do and whether it really is done falling or whether it has a further leg lower in it as you get more of this view cemented as likelier than what the Fed is saying. Might get a bounce in gold. Then, of course, we'll see if stocks can manage to sustain this disparity. Or if, in fact, this starts to look more sentiment-driven, whereas this is where we ought to be closer aligned with economic reality, and if that means that stocks now have a vulnerability and might pull back. And that is Macro Money for today. As ever, we are here Monday through Thursday, although because of the holiday, we are not going to be here on Thursday. It's a Monday through Wednesday kind of week here. And that's right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be on, as always, with Victor Jones for the Price of Truth on Tuesday this week. On with Victor again for First Call alongside Tom on Sundays. Writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on tastytrade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Coming up on Bad Money with Jim Blamer, Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, Dan Cecilia and special guest Cole Kennelly from Volmex. No stranger to the show. Cole, good to have you back on. How are you doing, my friend?
Hey, Ryan. Hey, Dan. Great to be here. Excited to be back. Looking forward to talking today.
Absolutely. You're here. So, of course, we're going to talk crypto markets. We're going to talk crypto market volatility. If anybody has a question for Cole or for us, I suppose, get your ass over to YouTube, pop out the chat, and type something in there. If we have any questions, we'll take questions, I suppose. But happy Monday. Hope you guys had a good weekend. Cole, to kick things off, for anybody that didn't catch you guys on the show last time, you're the founder of Volmex. Can you talk a little bit about how you got here, maybe hit on your background for a second? And what is Volmex? I think what you guys are doing is awesome, but would love to hear it from you.
Thanks, Ryan. So I'm Cole. I'm the founder of Volmex. At Volmex, we built the leading Bitcoin, Ethereum, Solana implied volatility indices. So we have the leading vol index franchise in crypto. We have a number of different integrations with TradingView, CoinMarketCap, Bitfinex, G-Trade, Gains, and have kind of achieved this ubiquity around this vol index standard in the crypto market. We also have a family of rates indices called the Volmex Prime Rate Index family, where we track different rates metrics across crypto market, like funding rates and on-chain lending and borrowing rates. So I've been following the U.S. equity options market my entire life. My dad has spent about 40 years working at a couple of different U.S. equity options exchanges. And so, I've got into crypto long time ago. I've been working in crypto startups for about 6.5 years. So I was an early employee at a staking company, which was acquired by Kraken in 2021. And so I'd worked there for a couple of years. And when I was there, I was trading, options and vol products in my PA. And I was really surprised that there was no sort of VIX standard. Around the same time, I was also experimenting a lot with DeFi. And so I kind of had this vision to build basically a DeFi version of the VIX for Bitcoin. And that's kind of the precipice for Volmex. So yeah, really excited about, where we're at today. We have a lot of different integrations in market, as mentioned. And, we're kind of at this inflection point around this Bitcoin volatility index and, achieving a real ubiquity and sort of omnipresence around it.
Awesome. And I think if anybody wants to check this out, we can throw it up here on the screen as well. We've got volmex.finance is the URL here. We've got your site up here. I don't know if there's anywhere you want us to bounce to on the platform, Cole, or anywhere you want us to go with the charts. Happy to pull those up. But maybe just to start off, when you look at what's going on in the market right now, you've got Bitcoin kind of flirting with all-time highs, has shown some resiliency here in the face of geopolitical risk, and clearly is well within the bull market. But volatility is at, last time I checked, a one-year low here, both realized and implied. What do you make of the lower volatility environment that we're in? What do you think is driving that? And then maybe what trade ideas or kind of opportunities do you see as a result of that low vol environment?
Yeah, so, it's a really interesting time in crypto. Bitcoin's hovering around 107, 108, around all-time highs. But we've sort of been a little bit range bound the last couple of weeks. And so I think that the advent of some of these Bitcoin strategy companies, Bitcoin treasury companies like Metaplanet, and several others, number of others, utilizing option strategies has taken a little bit of the juice out of the market. And so I think that has definitely played a role. MicroStrategy, Metaplanet, others utilizing various option structures, selling options has, sort of tapered vol down. I also think that the advent of IBIT options and the introduction of structured products in the U.S. Institutional market, I think, has definitely had an impact on vol as well. And so between Bitcoin treasury companies, structured product creation and growth in the U.S., I think that these things have definitely tampered vol. I would say that it's really interesting where the spread between the BVIV and EVIV indices are. For anyone unfamiliar, BVIV is a 30-day implied Bitcoin volatility index, and EVIV is the 30-day implied Ethereum volatility index. Basically, this is kind of at like an all-time high, as we've been printing these indices for about 3 years now. When the Bitcoin ETFs launched, the BVIV, was actually inverted EVIV for a little while. The introduction of Ethereum ETFs and then Ethereum options sort of, brought that spread back to like 10. Now it's around 25 or 30. And so perhaps there's a, besides just betting on, vol to sort of mean revert to, sort of like the average, over the mean over the last couple of years, I think that, playing some mean reversion around BVIV and EVIV spread could be really interesting, as 30, 25 is a bit of an outlier. And so really interesting time in the crypto market. I think, just today, there's, Robinhood getting in the market in a big way with their L2. You have, BlackRock, Fidelity, firing on many, on all cylinders. And I think it's a really exciting time in the crypto market. There's a lot of institutional interest, fervor, and, feels like Bitcoin is due for sort of a leg up. And so we'll have to see. I think that if Bitcoin goes to 130, 150K, you could see some positive spot vol correlation where, BVIV and Bitcoin become kind of correlated. As Bitcoin gets bid up, options get bid up, vol's increasing. And so perhaps we see some positive spot vol correlation when Bitcoin inevitably makes that move up to, 130, 150, let's call it.
Yeah. On that note, is there any catalysts or events on the horizon that you see kind of causing Bitcoin to maybe go up to that range? Or even on the EVIV side, like Ethereum, is there something where you see that spread tightening and coming back more in line with where it's normally been?
So I think it's, the fundamentals generally are quite strong. There's been many tens of billions of inflows into the, Bitcoin ETF market. Now, ETH ETFs are gaining adoption. You have things like Solana ETFs with staking coming soon. And so I think that just increased, growth in the sort of institutional products and, fundamentals, sort of just continuing to improve. I think that, we could see, Bitcoin just naturally sort of bid to 130, 150. I think the introduction of more sovereigns getting in the market. I think El Salvador in last cycle showed there is interest from sovereigns and buying Bitcoin on the corporate sovereign balance sheet. I think that more nations might start to do that as they do with gold, and so that could create sort of a flywheel of different countries, different sovereigns buying Bitcoin as some sort of reserve asset. And so I think that's quite interesting. And then obviously like the biggest companies in the world getting involved with Bitcoin, maybe on like a treasury level, maybe on the stablecoin level. It's been interesting to see like Stripe and Robinhood go deeper in crypto. I think we'll see more of that from, the JP Morgans, the Amazons, the biggest companies and corporates in the world. And so, really interesting time in crypto. I think that fundamentals are very strong and, who knows what's ahead.
Yeah, from everything that you see, it would appear that there's quietly this race to accumulate that's underway by bigger and bigger players that enter this market as it grows. Cole, you talked about the correlation maybe shifting back in terms of spot and volatility. Do you guys have a way to measure that here through Volmex? I think I was poking around in the charts earlier and I thought I saw something, but I can pull it up if you guys have something.
Yeah, so something we measure is the correlation between, Bitcoin returns and Bitcoin volatility returns, and ETH returns and EVIV returns. So we've actually created a series of indices called BV Core, EV Core, which basically measure exactly this: the return between Bitcoin over some time period and BVIV. And so, when the market is fearful, this becomes very negative. as does the VIX index, right? When the stock market crashes, the VIX spikes. You typically find a similar thing in the Bitcoin market. BVIP spikes when Bitcoin market is fearful. It's measuring sort of the risk in the market, right? What's very interesting about crypto is that, I was kind of mentioning before, when the Bitcoin market gets very greedy and bullish, you can observe that Bitcoin price is increasing, options are increasing, and then, vol is increasing. And so you can kind of observe this positive spot vol correlation anomaly, which you don't really see in the US equities market. And so, you can find this sort of anomaly in different risk assets like levered ETFs and such. And so, the EV Core family, spot vol correlation indices is a great, metric and indicator to kind of track this negative, correlation, positive correlation between Bitcoin and BVIV, or Ethereum and EVIV. So pay attention to that. As the market becomes more bullish, I do expect that we'll see some positive spot vol correlation, and, vol will be rising with the price of Bitcoin.
We have it up here on the screen. I'm not sure if you can see it or not, but we have the BV Core indices here. Do you have a preferred time frame that you like to use to analyze this or to measure it?
I think they're all pretty relevant.
Okay.
Maybe the 1 month is always a good, tenor, or 2 weeks. We can definitely link some of these in the, YouTube show notes and stuff for the users, and answer any questions. But I think that 1 month would be great, or, 2 weeks perhaps.
Awesome. Yeah, I've pulled this up, and we're looking at the daily here going back to about mid-January or so, and you can see exactly what you're talking about, right? You look at the rally that we had in May off of those April lows. I think we went from about 75 to 110 or so before pulling back, and that positive correlation between spot and vol just screamed higher from, a slight negative correlation, if any correlation, all the way up to, it looks like spot 4.0 at that point in time when we look at the 1 month here. So definitely a great indicator to keep your eye on through Volmex.
Thanks, Ryan. Yeah, we think this was really useful for traders and investors. Retail, pro-tail, institutions can all leverage this type of product to index for their analysis. Go ahead, Dan.
Yeah, no, I really we really love looking at this stuff. It's very relevant to our traders here, especially on the crypto side, because, as there's not very many volatility products out there or ways to measure this. So I'm wondering, on your end, since you guys are kind of expanding some of the indicators and some of the indices, is there any other tokens that you're constructing these volatility indices for? Is there anything interesting that stands out when you're looking at some of these altcoins?
Great question. So we have an SVIV index for Solana. And so, zooming out, Volmex is kind of constrained to implied volatility indices, creating implied volatility indices around assets that have liquid exchange tradable options markets. And so, the crypto market structure, you have Bitcoin, Ethereum. There's a pretty big drop off after those two major assets. Solana is kind of the next biggest asset that has critical mass in the derivatives market. Deribit has listed XRP, and so we plan to roll out an XRP implied vol index, which, if you look around, you might be able to find that, teasing some alpha for listeners. And then there's a couple of other assets that have liquid, pretty deep and robust options markets, XRP. And so, really it's BVIV, EVIV, SVIV, which are kind of the flagship implied vol indices. We plan to roll out XVIV for Ripple and XRP, and then we'd obviously like to do it for as many assets as possible. Something we're really excited about is the advent of the future, coming of a proper top 10 or top 15, maybe top 7 index, which has options on it, right? Because then we could really easily construct a top 7 vol index, which is sort of missing in the market right now. And so, it's really interesting. There's sort of no canonical standard for a broad-based sort of top 7, top 10 index. And so there's a CD20 by CoinDesk and Coinbase 50, which are potentially synergistic initiatives to what we're doing at Volmex. If we can get options on those, we could price a top 50 or a top 20, implied vol index. And so looking forward to that. I think it's really exciting what could be done. There's a couple of other assets. I mean, Deribit has PAX-G, which I don't think there's enough liquidity per the last we looked at it to create implied vol products on indices on that type of product. But we definitely would love to support as many coins and tokens as possible. But there's definitely the most interest in BVIV, right? Our Bitcoin 30-day implied vol index. One note, we do have an entire term structure, right? So we have BVIV 7-day, BVIV 1-day, BVIV 14-day, 30-day, 60-day, 90-day, 120, 180, or those might be in staging still. But we have all entire tenors, various tenors of BVIV. And so you can sort of look at the vol, term structure and see like where things are at. And so I believe if you, Ryan, if you search BVIV and then scroll down on the page, you'll be able to see that that term structure.
Yeah, we've got BVIP here on the screen. I've got a current price of 39.77. And what I love about this as well is you've got the IV rank, same way that we tend to approach it here on tastylive. You've got the percentile as well. So everybody can see that we're at very, very low levels of volatility. And I'm assuming this is maybe a 1-year time frame you're looking at, but you'll see the same thing on a 3-month, a 6-month basis. Vol is very low. And as we scroll to the bottom of the screen, here's that term structure that Cole is talking about. You can see where we were in terms of implied volatility 2 weeks ago, 1 week ago, and where that is currently. It gives you a sense of just really how flat that curve has become over time. I mean, in my opinion, obviously, cheap vol can get cheaper, but if you believe that we are going to see a move higher, there's fundamental reasons to believe that Bitcoin can get to those levels you mentioned, 130, 150, whatever it might be. There might be an opportunity here to buy some longer dated kind of upside optionality through call options, buy that upside tail risk, because arguably it can get cheaper, but it's pretty cheap right now versus where it has traded in the past.
Well said, Ryan. I mean, could be a good entry for, different option structures, vol cheap, of low, meaning, it's, less costly to enter those type positions. And so very interesting where we're at right now.
Yeah, we've been doing a bit of that on the show, just trying to buy some, 95 strike calls, 5-10 delta calls, kind of taking a flyer here on some upside in IBIT. Not so much based off the idea that you're going to see the price double or go up 50% in the next couple of months, but just simply that your option on a per strike basis, which is trading at a, say, 45, 50 IV, maybe that gets back to 70 on that delta move. And you do see, a nice increase or profit as a result of just owning a bunch of those upside call options. We'll see. But again, when you look at it from this lens here and you go back to what we're showing here on the Volmex dashboard, where the IV rank is 2.5, percentile is 0.29. I mean, you are at the cheapest levels that we've seen. And I'm assuming, is this a 1-year scale that you're looking at?
Precisely. It's a 52-week high and low. So basically we're at the lowest range of the lowest end of the range. Vol has sort of never been lower over the last 52 weeks. And so, we could see some move to the upside based on that, or whether it's negative or positive move, right? I mean, you could see sort of negative spot vol correlation if the market moves down a lot, which, obviously a lot of people are bullish right now. Personally, I don't think that's as likely, not financial advice. But then if the market moves up, you could see some, positive spot vol correlation. And so could be a pretty attractive bet to, long some vol or long some options and inherently long some vol. Talking my book, though, I mean, I want to see more trading, and
me too.
We're all options guys.
On that note, on the trading note, you recently launched the BVIV index on Gains, right? And Bitfinex, it's available on Bitfinex, but you recently launched the tradable indice on a platform called Gains Network. Could you take us through that a little bit, like how that works? And I could have Ryan pull it up, but just want to discuss that, because these indexes are tradable if you're, in DeFi.
Yeah, sounds great. So I can send you the link, Ryan, if you want to pull it up. That's helpful.
Yeah, I think I've got the Bitfinex derivatives, and this isn't going to be accessible to everybody. If you're watching the show in the U.S., probably harder to access this market, but this will give you a sense of maybe what's coming soon globally, but how you can trade the actual index in the same way that you could trade VIX futures or buy options on the VIX.
Yeah, so BVIV is an indicator, right? You can use it to understand expected risk, expected volatility, expected moves in the crypto market, but it's also a tradable product. BVIV is very versatile. And so, in the crypto market, in the equity market, obviously there's a entire complex of futures, options, ETPs, ETFs, OTC products that all make VIX tradable. Our vision is really for that, very similar complex of futures, options, tokenized products, what have you, to make BVIV tradable. And so today we have 2 perpetual future offerings that we've partnered on that make BVIV tradable. We have Bitfinex, which is a sister company of Tether, which is really exciting because, sort of buy-in from the Tether cabal, into our product, which is great. And then we've also recently launched a collaboration with Gains or G-Trade, which is a decentralized exchange that trades on Arbitrum and Base for the last couple of years. And so just last week we announced a collaboration with G-Trade. Basically, we pipe our data into the G-Trade perpetual futures exchange, and they make BVIV and EVIV tradable through their exchange, which is based on smart contracts on both the Base and Arbitrum networks. And so we've seen about 1.25 million US notional traded over the last of contracts traded over the last 6 days or so. And so I think it's been a major success. There's been a lot of exchanges reaching out to us about doing something similar. And so, we do have a pipeline of various different exchanges that, want to list BVIV across CeFi and DeFi. And so really we're building this ubiquitous, vol index standard for Bitcoin where you can find BVIV on, Bitfinex and CeFi, Gains, and soon other dexes, in the DeFi world, and ultimately want BVIV to be on every major exchange. And so, if you'd like to hedge with this type of product, with the, negative correlation once, BVIV, spikes during a sort of negative, bearish price action, or, bet on the positive spot fall correlation or bet on mean reversion speculation. This is a pure volatility product that allows you to express a view on implied vol without managing a multi-legged option structure. And so this is actually a major unlock for the crypto market, where for the first time ever, you can just buy one single contract with a couple of clicks, or really one click, and have exposure to pure implied vol, which previously wasn't really possible. And so really excited about the progress with the G-Trade. There's going to be a bunch of other exchanges that list BVIV, and so super excited to share those with everybody.
Starting with BVIV, do you see an opportunity for tradable products around EVIV, the Solana Volatility Index, XRP eventually, and others? Do you think that's what's next?
So BVIV and EVIV are both tradable on Bitfinex and Gains. Maybe I wasn't clear. We definitely want to see more implied vol indices tradable on our different partner exchanges. And so perhaps SVIV will be tradable on-chain on Solana at some point, or just BVIV generally. And so, yeah, super excited about bringing BVIV and EVIV to more exchanges across CeFi and DeFi, and also making some of our other indices tradable. Perhaps this is a good segue into, the Volmex rates indices, which we rolled out a couple of months ago and track different metrics, like funding rates and, on-chain borrowing and lending rates. Basically we saw, in the equity market, there's obviously SOFR and LIBOR, which have become very, LIBOR no longer, but SOFR has become sort of the standard for, pricing credit, lending rates. And so we sort of noticed that there was no such standard in crypto, and built this family of indices called the Volmex prime rate indices. And basically we have a vision to, build a standard for interest rates with the Bitcoin volatility, a Bitcoin prime rate index, which we've created, Bitcoin Volmex prime rate, and eventually make those tradable. And so I definitely think that some of the exchanges we're on already and some of the exchanges in the pipeline would like to list the rates indices that we've built. And so we'd like to see many more Volmex indices trading in both CFI and DeFi.
Awesome. Yeah, we have those prime rate indices up here as well. And then I guess out of curiosity, is this something where you might see the market extended one way or the other? Let's just say that it's very expensive to finance a perp position. That could be a signal that you would look for in terms of a short-term reversal, or if you wanted to trade this, if it was a tradable product, you could short that rate. Is that how you might think about it?
Yeah. So I think as the market becomes more bullish, the demand for leverage increases, and you should see that reflected in some of these Volmex prime rate indexes. The DeFi lending rate specifically measures the cost to borrow stable coins against your Bitcoin on venues like Aave, Morpho, and Compound. And so the demand for borrowing, increases as the crypto market becomes more and more bullish. And so you can also observe something similar with funding rates, to get levered long via a perp position. And so I think that you could sort of trade that sentiment via these rates products. And so we think it's a really powerful primitive. It's really surprising that there's not more adoption, not for these products specifically, but just broader, rates trading in crypto. I think that perhaps after the 2022, some of the stuff that happened in 2022 with folks like Genesis and BlockFi, the crypto credit market kind of dried up a little bit. I think as that comes back with the introduction of institutional players, we'll see a lot more people and firms and pro-tail, retail, institutional want to trade this type of product. And so very bullish on the prospect of, rates trading as of course, vol trading in crypto. So yeah, definitely you can observe like sentiment being reflected in this type of product.
Awesome. Yeah, and I think the one other thing I'll mention too for everybody that's following along here with us, we a couple times a week put out an email and a data dashboard, and we'll construct one standard deviation expected moves based on the volatility. So we just take the spot price, take the current implied vol for Bitcoin or for ETH using some of these numbers here. You could use the 30-day index if you want to. That's what we typically will use, and that can be a great way, I think, to kind of come up with realistic expectations for a trading range. You can use the input here from Volmex, use the spot price, and you can calculate that one standard deviation move. So you get a sense of what's realistic, right? Everybody thinks that Bitcoin can go up $50,000, but over the next month, what is the option market actually pricing in? Is it a $5,000 move on a weekly basis? Is it a $10,000 move? You can start to understand what different vol inputs ultimately look like in that calculation. And so this is a great resource for some of that if anybody's curious as to how we calculate those ranges.
Yeah, and that's a good point, Ryan. And we'll have to add some of these indices into the newsletter going forward because I think it is a good complement to our dashboards. Real quick, Cole, because we got about a minute or so left. I have a question from the chat, which I thought was interesting. They asked how you will compete, Volmex will compete or work with CBOE and CME when they inevitably start getting into these type of things.
Yeah, so the U.S. capital markets are the deepest and liquid and the most liquid in the entire world. We are very excited to build products that are, regulated and tradable in the U.S. market. And so we have a couple of initiatives behind the scenes where we're working on, bringing, regulated data into a new family of indices and creating, some of these type of products. And so potentially, those type of firms could be partners to Volmex or their peers. And so we definitely would love to, integrate with the biggest exchanges in the world, which sit, in the U.S. typically, and offer these products to U.S. retail. And so super excited about that. I think, the Bitcoin ETF market and the options on those markets is a perfect backdrop for those type of products, and should make for a great foundation for U.S. tradable products for vol and otherwise. And so that's a great question, and we're definitely really excited to enter the U.S. market. Obviously, the perpetual products are generally available outside the U.S. right now, but that's definitely on the roadmap.
Well, Cole, that's going to do it for our show. Sadly, we've run out of time. I'm sure we could talk to you for many more hours here. But excited to see what you guys do next with Volmex. If anyone is interested in checking out what you're doing today, volmex.finance. And if they want to hear more from you, where can they find you, whether it's on X or anywhere else? What's the best way to get a hold of you?
So follow Volmex on Twitter, VOLMEX Finance on Twitter. You can follow me as well, Cole Got Tweets. Check out our charts, charts.volmex Finance. Check out our website, volmex.finance. Add BVIV, EVIV, SVIV to your TradingView watch list. If you search for Bitcoin implied, Ethereum implied, Solana implied, we're the top result. We're also in the CoinMarketCap mobile app. And then if you'd like to express a view on BVIV, EVIV, you can do that via Bitfinex, Gains, and soon more. And so definitely stay tuned with what we have coming. We have a lot of big plans. Thanks so much for having me on the show. Always a pleasure. Looking forward to next time. Thanks, Dan. Thanks, Ryan.
Absolutely. Looking forward to having you back on the show as well. But that's going to do it for our show. Until then, I'm Ryan.
I'm Dan.
Peace.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on tastytrade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Oh, yeah, it is Monday, June 30th, last day of the month and the quarter, a little bit after 5 p.m. Central Time. The best time, you know what that means? It's time for Tasty Live's evening show, a little podcast, little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and we got a handful of them today. They're definitely making us earn our money. More on that in just a bit. For now, we should say what's up to all the people watching. Shout out to everybody watching on Tasty Live desktop,
Excuse me. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. Do yourself a favor. Just make your life much easier. Go get both of them. But if you want to be part of Bing, this little guy, this little chat box on your screen, there's only one place to do it, and that's over on the evil Google YouTube. So head on over to head on over to YouTube, subscribe to the Tasty Live channel, and start moving those phalanges, those metacarpals, even bash your face into the keyboard to create random ass characters, and spoof the Google algorithm into putting us in front of as many people as possible, and live stream your thoughts onto this little stream. Put a little part of your thoughts, little imprint from yourself on this stream. Make it yours. Shout out to everybody already in the chat. I see all of you. Shout out to Lone, Gary, I see you. Mark, great to see you as well. Cato, what's up? Martin Walker, great name. And all of you, I would shout you out, but I'm contractually obligated to say something that might be construed as meaningful or substantive. So off, and away we go. S&P 500, my babies, climbs ever higher. S&P 500 up 0.5% today. The NASDAQ up 2/3. Dow Jones up 2/3%. The Russell, the little engine that could, trying to do something to the upside, but not really able to do much. 12 basis points to the upside. The distance, the performance distance between the NASDAQ and the Russell has never been greater. We've surpassed, if I'm not mistaken, levels that we saw during the dot-com bubble in the late 90s and early 2000s. That's where we're at right now. Everything's fine. Everything's fine. What's up, Catan? But doing some numbers here in the NASDAQ, and just, I don't know how you guys feel. I'm sure some of you sort of enjoy 0.5% climbs higher each and every day. But that's not really my style, my friends. I like when things are rocking and rolling, people are scared, and we're playing poker. In the world of 0.5% moves to the upside, everyone starts to think that they can predict the future because the distribution curve has kind of condensed. It's not as wide. And so when there's a little bit more, quote unquote, uncertainty in the future, people start pretending like they can predict the future. They make bold and boisterous and proclamations about the future. To me, I don't really particularly love that environment. What about you guys? I like when the distribution goes wide and it reminds everybody that you don't know what the future holds, and you never did. And anyone that claimed to, they sort of get exposed for what that racket is. But right now, we're in the proclamation phase, everybody. I can read you a set of headlines that could prove what I'm saying. And by the way, I love Dan Ives. He's a great guy. I've done a couple of podcasts with him. He's super generous with his time. And, he wears the wildest stuff I have ever seen. But I'm going to give you an example. Here's a headline. This is over on CNBC.com. Analyst Dan Ives says it will be the summer of $4 trillion market caps for surging tech giants. Rick Reeder says there's a generational opportunity for income right now. I could go on and on down the line. If I'm not mistaken, the gentleman from Morgan Stanley is on television right now telling everybody about the future. Just not my style, man. But VIX at 1673, a little bit pop in the VIX, 40 cents or so, but /VX has not moved. We're at 18 and change, and the VIX term structure looks the exact same. You can basically take a picture of this and put a sticky note up on your screen, as it's called. Front month futures are almost always in the 18s, and back months are almost always in the 22s. And this thing doesn't have much of a slope to it. That's exactly what it's looked like for the last couple of weeks, and it is not changing. It does not seem like it wants to change anytime soon. I wonder what the moment will be that unclenches sort of vol to one direction or the other. Is it getting past this 90-day pause window? Is it signing some meaningful trade deals and getting to ultimately to this 10% universal tariff rate, which we're going to get to at some point in time? Is it a new administration? Is it appointing a new Fed chairman? Like, what is the thing or the set of things that sort of allows vol to normalize? And when I say normalize, I just think to be in back month volatility in the 22s, almost all of them flat, and then front month at 18, it's sort of I don't know. I haven't seen that very often, put it that way. Let me pause for a second, see what you guys are squawking about. The future, Conan. Oh, I miss those. Those were the days. I actually want to talk about a lot of stocks today, but before we get there, I'm obligated to just hop on over to the bond market. Another sort of very boring trade, but it is working. The play from me was at some point to start betting the upside in bonds. It's not a fun it's not a sexy trade right now. There's not a ton of volatility here, so it's totally directional, and there's not a lot of gamma here. There's not a lot of speed. It is working. We are moving to the upside from 109. We're now at 115, which is a bit of a resistance area. We're at 115 and 30 seconds. And I think we can get past this little congestion area at 115, 17, next stop 117. And that was my play, that we could see bonds get back to this 117 pivot point. And, we'll see if it happens. We're getting close though. When I made the bet, I think we were at like 112, 110. No, not 112. Like 110, something like this. 111. So it's been a slow grind, but we're almost there. Just a quick look at the yield curve here. The long end of the yield curve is settled down a bit. We're no longer pressing 5%, 4.78 in the 30-year, and the 10-year at 4.25, which seems like that's probably the level. It seems like the 10-year between 4 and 4.25 is probably the level we're going to settle at here. And I just don't know there's going to be a lot of fireworks. Same amount of cuts priced in effectively starting in September. And I'm very curious. Do you think so? The market now has 3 cuts priced from now until the end of the year. And we keep playing this over and under game. And I'm fascinated by it because the market moves fairly quickly. At one point, we had like 3 or 4 cuts. I was like, that's not happening. Let's take the under. Then the market moved to almost 1 cut. I said, that feels too hawkish. Let's take the over. 2 weeks later, we're now pricing 3 cuts. It seems like the bond market, the entirety of the curve, is starting to see one of 2 things, if not both. Starting to see slower growth, starting to not be as concerned about inflation as the overall narrative that the Federal Reserve is trying to sell. We had said at the beginning of the year that the tariffs were going to be a really convenient aspect for the Federal Reserve to use to sit on their hands and not do anything. And that's exactly what's happened. But in order to not do anything, as people see growth numbers come down, they have to be concerned about inflation. And I suppose we can say inflation we're not down to 2% in the official numbers. True inflation and a lot of other data points are saying something different. But in the official numbers, we're not anywhere close to the Fed's target. So on one hand, inflation has not gone away, quote unquote, the painful inflation above 2%. But on the other hand, there isn't a ton of evidence that you've seen this big tariff price shock or that you're going to. because I think a lot of people, and I'm in this camp too, think there's going to be demand destruction based on higher prices at this point. That we're going to see elasticity of demand, that the consumers have blasted through a lot of their COVID savings. And as unemployment ticks higher, that's going to create a slow, if they're lucky, a slow destruction of demand. I'm sort of in that camp, which is one of the reasons why I'm taking this very small, I don't want to say it's small, but like this risk-defined upside bet in bonds, and why I continue to go back here and talk about it. Taif, I'm going to take a moment, just read a couple of comments, and we'll get done with a couple of more topics. Victor, Taif says that's what's annoying about this BS. I wonder what happened to all the Trump hate. Gone now that markets are back in highs. Was and always will be about the dollar, nothing more. That's why he pivoted. Dollar slash rates. I'll say that. And there's still, I don't know what you mean, where'd all the Trump hate go? We're still a 50-50 polarized environment here, my friend. Let's see here. Logic say we should be 68% if the economy is strong, but the market seems to be pricing in recessionary rate cuts. Thoughts? Yeah, I think some part of that is true. I don't know if it's recessionary rate cuts, but I do think some part of that is true, that the market is now getting pretty dovish in what they're doing with the curve. And I think that's gonna be pretty difficult for Jerome Powell to ignore. I don't think he'll move in July. I don't think they'll move in July. I think they'll wait. And I think ultimately September, you'd need a miracle not to be able to move rates in September. Like, he's going to need a really, really hot inflation report, and he may get one. I think just based on base effects alone, he could end up getting a hot inflation report between now and September, which could give them the ammunition to not go in September either. I don't know that I'd bet that, though, at this point. Yeah, I don't know that I'd bet against the curve right now, saying that rate cuts start in September. But the biggest problem, here's the biggest problem. Am I long dollars, Victor? No, not right now. I had a long dollar trade against the euro, but it was really short term. I'm not really I played this fade. But that's about all I've done in the dollar in quite a while, directly. Let's see. Oh, he cut me off where I was going there. Yeah, I wouldn't bet against the curve here. I think it's probably about right. If we get a hot inflation report, then that all bets are off. And that's what'll be interesting is if we get sort of a warm CPI between now and September, this whole thing, the whole 2 years, is going to shift, which is why I really like talking about and trading the 2 year, because we've had this schizophrenic market that can't figure out, are we going to get 3 cuts, or are we going to, in the next couple of months, or are we going to get none? And so I like that tension. I think we're going to keep getting this volatility in the 2 year. So I like the 2 year or ZT futures as a trading vehicle. Short dollar has been one of the best trades on the board. It definitely has been. Dollar's getting absolutely smoked. They are turning that stuff into toilet paper. Congratulations. Congratulations, everyone. Here's your Zimbabwe dollars. And Bitcoin's not doing a damn thing, which is kind of a head scratcher, is it not? Yeah, we'll get there in a second. I'm fascinated by a couple of stock moves here today. I normally don't do this, but I'm fascinated by this story. So I'm going to go here. I'm going to talk about a little bit more stocks. Stock stories today was this Robinhood story. First of all, it's up 13%. I cannot believe this thing is nearing $100. I bought this stuff in the single digits, I think. maybe like 8, 9, 10 bucks, maybe 12 at the most. And I thought when it was at 25 or 30, I was like, damn, good. I'd be patting myself on the back, like, good trade, Victor, good pickup. And we're nearing $100. That is absolutely wild. I'm going to read the headline, the sort of the catalyst of today's move in Robinhood. Robinhood gives out tokens of OpenAI and SpaceX in Europe. They're now offering tokenized shares of OpenAI and SpaceX to users in Europe, sending its shares up nearly 13%. The company's making the launch by giving €5 worth of OpenAI and SpaceX tokens to every eligible user in the EU who onboards. So effectively, in the U.S., if you remember, they were one of the first ones to do sort of the free stock giveaway when you opened up an account. And it could be anywhere. It could be a couple of bucks, like $5, or it could end up being $200, $300 worth of stock. And the idea that you're giving away tokenized shares of OpenAI and SpaceX, which are non-publicly traded in the U.S. markets, obviously, that's a pretty exciting move for people to. It's a pretty exciting incentive to get people in the door in the European markets. I got to give it to them, man. That's a pretty dope marketing launch for sure. But we're at 95 bucks. That's absolutely insane. What do you think? What would you do for tokenized shares of OpenAI and SpaceX? Would you move to Europe? Yeah, Palantir, after a 9% dip. I was talking to Nick in the green room before first call on Sunday, and I asked him, it had a 9% about a 9.5% pullback on Friday, and I asked him, do you buy the dip? Sort of as a tongue in cheek, but I was being dead serious. And he goes, no, it's not ready yet. And I go, man, this thing doesn't give you much of a chance. And interestingly enough, you got a 4% upside move. It didn't recover all of the damage from last Friday. But I would say it's a pretty healthy bump at 4%. Tom Banjo says, I'm shorting that stock. Which one? Tom's going to delete Victor. Which one are you shorting, Tom? Are you talking about Robinhood or Palantir? Which one? I'm going to keep moving here. Another one that had a pretty decent move that I hold today was up 11%, which is Joby Aviation, JOBY. This is one of my sort of like, you'll all own nothing and be happy globalist basket. I talked about some of them on Sunday. HIMSS. So this idea that, you're going to need to pay to have children. You have to pay to conceive at some point in the future. So HIMSS on the front end, and then Progeny, PGNY, sort of like it's a fertility company. That one's been sort of a dog. It hasn't really moved. I like the theme. There might be a better way to play it. But then there's the sort of the drone, the electric vehicle angle on this. This got overhyped sort of in 2020, 2021, when a bunch of, like that post-COVID era, when a bunch of people had more money than sense. And so they bought up like the electric vehicle stuff. And the drones got hot for a little bit as well, and then they left them for dead. Now there's sort of this resurgence. JOBY is one of my preferred plays for just the idea that you're not going to leave your house, and eventually there aren't going to be delivery drivers. There's going to be robo-taxis picking you up, and you're going to swipe something on Amazon, and a little drone is going to take it from a warehouse and drop it off on your doorstep. You might laugh now, but give it like 3 years. And so this is sort of my angle. This thing was up 12% on the day. So just throwing it out for you. Another performer on the day, even though the indices are not doing anything. The indices are so incredibly boring at the headline level. But obviously, there's really decent movements if you look a little bit further. CCJ puts a 1% on the board after being weak on Friday. And then SMR, which is my high beta play in the nuclear space, was up 3.5% today. So, and this thing's gone crazy too. I think I got this in the single digits. I think I'm up like 700% in this thing. Absolutely crazy. But you know what happens when you smoke your own currency? Gold, you know, your precious metals, your rare, I don't say it like that. Your rare assets. That's not the word I'm looking for, but I'm going to keep moving here. 3,300 held. Jeez, Victor, I can't believe you do this for a living. 3,300 held in gold, up around 1/3% after sort of looking like it might have wanted to violate this level, 3,300. We held, and along with it, my babies, the miners had a nice little day. Newmont Mining was up something like 2.5%. If you like to play individuals, the junior miners had a pretty decent day, up 3%. Silver miners, PAS, had a pretty decent day as well. Pan American Silver. This is one I like. I've been playing silver. I think 36 level holds for silver. I don't know why. I shouldn't say I think it will, because I have no idea. I'm betting that it will. So I'm betting that we've established a new range up here, that 35, 36 is a bit of a new floor, and 38, at least in the short term, looks like it's upside range. And if so, you know, I still like the silver miners, even though PAS looks like it might, you know, what are the odds we fill this gap? I'd say pretty high. I'd say pretty high this week. This island breakout to the upside. I wouldn't be mad if we could go back and fill this gap and I could pick up some of this stuff a little bit cheaper. That's the thing. Finding value right now, it's tough. There's not a lot of things that are like cheap. You can find relative value, but there's not a lot of stuff right now as at all-time highs. I don't think I'm saying anything that's shocking, but you can't find a lot of cheap assets. It's all a relative game right now. And those are the most boring games because those are the buy high, sell higher games. Super low vol, grind higher. And the only value to be had are things that are cheap relative to other assets. Except, and I know some of you guys are getting sick of me talking about this stuff, but except the home builders. I would say these things are actually relatively cheap. And I think if bonds continue to move higher, and I think if the dovish aspect of the curve is right, and this is a big if, so the markets are now pricing in more cuts. The markets are getting more comfortable buying up U.S. debt in the long end. 4.25 seems to be a comfortable area for the 10-year. Now the question becomes, this is a big question. As we get closer to September, if you don't see any inflation reports that spook the Federal Reserve away from moving in September, that's your first hurdle. And if they actually cut in September, then if the long end does not throw a temper tantrum, meaning the long end yields don't move higher. This is what happened last year. When the Federal Reserve cut rates, the long end rejected that cut. The whole curve did not shift down. We got a steepening in the curve, which means the short end came down. The long actually lifted. And people are like, hey, man, what gives? And you got a lesson that the Federal Reserve controls the short-term interest rates. The market dictates long-run interest rates. And if we see another situation where the Federal Reserve lowers short-term interest rates and the long end says, F you, I'm not moving, like a Wolf of Wall Street, F you, I'm not leaving. If you see something like that, we are in I can't tell you how much of a bit of a pickle we're going to be in, how crazy of a world that's going to be, because the market is going to effectively tell you that the Fed has no tools. The only tools, I shouldn't say they have no tools, they would effectively at that point have to do some sort of operation twist or yield curve control if they wanted to influence long end rates. But you would basically be looking at a situation kind of like what we've been seeing for the last year. Like the Federal Reserve can't do anything. They're going to need to just sit down and wait and watch unless they want to do yield curve control. That's a wild world to be in. But if you imagine we don't see a hot inflation report, that they start cutting in September, and that the long end accepts those cuts and eases ever so slightly, just looks like it's going to play ball. And that's a lot of ifs, my friends. But if you get all of that, I actually do think we're in an interesting environment to buy the home builders. And I know Pulte has been all over CNBC, just absolutely ripping the Federal Reserve, saying that they need to cut. They're going to be late. I know the president has been saying this. I know a lot of people are saying this. I'm not 100% convinced that they're right, because if they do cut and the long end rejects it, we're in Pain Town. We're in Crazy Town at that point. We're in Banana Republic. And I'm sure Powell and the Federal Reserve do not want that outcome. I'm 100% sure that's not the outcome that they want. And that's why they're going to wait until they're 100% certain that a cut will be accepted by the bond market. And I say all that to say this: if all those things are right, I think you're getting a pretty decent price on home builders. And so I'm going to keep accumulating, and I might just absolutely wear this. And I keep taking these bets. I keep taking these bets that could end my career, like the silver thing. And I'm just getting lucky that some of these things are working out. But this is the next one. This is the one this is the one that ends me. The home builders here. You are seeing some recovery in some of these. You don't think of them as a traditional home builder, but like these guys got just destroyed. Cavco Industries, they basically make trailers. They got destroyed, and they're seeing a nice little rally off of 400. I mean, they've already recovered 10%. So this was just as a trade alone, it was interesting since the point we started talking about it a couple of weeks ago. The problem is most of the options markets for all of these underlyings are trash. They're absolutely trash. So it's basically a stock play. Look at these at the money. Look at these options. 8 by 17. Good luck. So these are basically all stock plays. Even, I think, what's the biggest home builder? I think this one, D.R. Horton, is the most liquid. And look at these options. 30 cents. So, pick your poison. These, unfortunately, are not going to, if you want to go to Crazy Town with me and start scratching around with these home builders, you can. Obviously, it's your money, but just know that they're stock plays for me. They're not option plays, because the liquidity in the option markets for all of these underlyings are so poor, unfortunately. Let me take a moment, see what you guys are talking about. If you want to be a contrarian but still bullish, get the defensive stuff that everyone loved earlier in the year. They're on sale. XLP, XLU, XLV, etc. Even better if you do homework and pick single names. So Taif, I really like this point. And I like it. I like healthcare especially. So there are aspects in healthcare that I agree with you 100%. People left this whole space, they left it for dead. And they left it for dead because almost instantly after the market had decided that Donald Trump was going to appoint RFK Jr. as the Secretary of Health and Human Services. Almost instantly, the market was dumping all of these underlyings. So I like that theme. I don't love a lot of the sector ETFs like XLV, XRT is the absolute worst. A lot of those sector ETFs, like even XLE, which is the energy ETF, I don't love them. I don't really love the construction. Even XHB, the home builders. Word to the wise, don't trade one of these sector or industry ETFs based on its name and based on what you think it does or should do. Open these things up and see what the holdings are and see what the percentage weights of each of the underlyings before you trade them. That saved me a lot of heartache, just opening these things up and going, what is this? If I buy this, what do I actually own? And I've said this a couple times on the podcast, but just in case you're new or this concept is new, XLE, for example, is nearly 50% two stocks, ExxonMobil and Chevron, which are big sort of blue chip names. So if you wanted more vol, you probably wouldn't use XLE. If you wanted exposure to energy, you might go pick individual names, maybe higher beta names, something to this extent. Maybe you wouldn't. Maybe you like the idea of buying an ETF that basically only gives you exposure to two stocks. Maybe you like that. I don't. XRT is an example of another one. It's a horrible, they might have changed this, but this used to be the worst ETF, in my personal opinion, at tracking versus what you think it is and the actual underlyings in that company, or excuse me, in the ETF. Same thing with the home builders. If you open it up, there is some home builder exposure, but there's like a lot of Lowe's, Home Depot, a lot of building supply companies, which is fine, but you just need to know, like, it's not a direct home builder exposure. I think one of the only things that's actually good is the Jets ETF. Now, liquidity aside, this thing is 9 airliners. There's no other weird stuff that they put in here. Anyway, that was a weird little aside. Let's get going. But anyways, back to the point, which is, I do agree with you that defensive themes, if the market gets a little rough, which we are not pricing, but if the market does get a little rough, then defensive themes, if you get there first, okay, if you get to the theme first, once you start seeing the articles that are posted of like you're in a recession or you're in a growth slowdown, and like what, now you start seeing the 5 stocks that work in a recession or 5 stocks that will pay off in a growth slowdown. Once you start seeing it, it's too late. Usually those underlyings have already made their moves, and now your exit liquidity, you're reading it going, oh, maybe I should buy the consumer staples, and you're providing exit liquidity to people who already played that theme. But now I would probably argue it's early. But I've never done that. I've never played I think playing the staples into a recession is a sucker's bet. I'd rather go cash, or I'd rather have my money in gold or something like this. The reason people go to staples mostly, they'll say is like, oh, well, you still have to buy toothpaste in a recession. That's what everyone will say. But really, staples are low beta. So a professional money manager, if they have money, okay, people give them capital. They can't, in a recession or during high periods of volatility, they can't go to cash. Because if you ask somebody, you're paying 2% of your assets to this person, you go, what are you invested in? And they tell you you're in cash. You're like, are you out of your mind? I could take my own money, put it in cash in a checking account or in the treasury and get 4 or 5% of my money. Why am I giving it to you to lose 2%? So they can't do that. So what they do is they go buy low beta assets. They have to buy something. So in growth slowdowns, they go buy low beta assets, and staples are one of the lowest beta assets. And yes, it is true that you still will see some consumer demands in those things, but it generally is not going to pay. Generally, correlations go up. Generally speaking, this might be a unique circumstance because we're turning our currency into toilet paper. So nominal prices may lift, but I'm speaking more broadly as a concept. Generally, these things don't actually pay. You're not going to make money in them. They're just going to lose less money than the overall market, which is why professional money managers use them. But they pitch this idea during a growth slowdown to everybody, and sort of but I would say there's usually not much money to be made unless you get in there early. You wait for the professional money managers to realize, oh my God, I need to be in low beta assets. Then these things lift. You sell it to them, then you're out. Yeah, but anyways, I don't know. I'm going on these weird tangents today. I do think speaking of cheap assets or it being hard to find cheap assets, I think there are a handful of names in healthcare that are fairly cheap. I think home builders are cheap, and there are some names in healthcare that are still cheap. This Moderna being one of them. I don't know if they've done irreparable harm to their brand. But if the globalists win, man, there will be a resurgence. Mark my words. I'm crazy. I'm out of my mind. Pfizer, not bad. A little bit of a rally here. Yeah, they're starting to realize that these things were too cheap. Eli Lilly, this thing never moves. So $780 stock always. Yeah. But there's a handful of these I do like. And I should probably pick up some more, honestly. Catan, we're here for you, brother. I appreciate it. Catan says Lilly is the one to track. Moderna can't make a profit. I agree with that, Michael Anthony. But, never. It's basically a bet on manufactured crisis. If you know, you know. It's a bet on, I did the same thing. Now I can't even remember the ticker symbol. But when the bird flu headlines started floating around, I was like, all right, who's got a bird flu vax? And then there were basically three companies. One was had decent liquidity, was publicly traded, and we caught a sick little move in that. So I don't know. It's not, put it this way, betting on these companies is not betting on like natural profitability. Okay? Betting on these companies is a bet on one of two things: a growth slowdown, and so capital flows go, oh my God, I'm only in Nvidia. I should probably go get some healthcare or certain consumer staples. Meanwhile, we've been buying up these things at rock bottom prices, and then people figure out, oh, I need to be exposed and defensively positioned, and we go, okay, here's your stuff at much higher prices. It's either that or you're betting on manufactured crisis. So the question you have to ask yourself is, what's the right price to bet on either of those things? I don't love Moderna, by the way. I just think it's too cheap to not take a bet, for me personally. If I was I'd bet on something else. I'd bet on like probably Pfizer, Eli Lilly, Merck, something like this. But I think Moderna's kind of too cheap to not bet on. I'm probably wrong, though. Taif says, what's interesting is I asked Copilot, which one is Copilot? Is Copilot Microsoft? I asked Copilot, what are some non-correlated stocks? Listed the following sectors, stocks: Moderna, Duke, what's that, NextEra Energy, I think, CVS, Procter & Gamble, and Coke. To be clear, it listed those as examples. I think I own NextEra. Novo. Yeah, here's the other one we talked about on Sunday, which was Hims. A nice little gap down last week. This is the most schizophrenic stock. It can't figure out if it wants to be $70 or $30. But from a trader's perspective, in a world where you've only got a 16 vol market, if you want heart palpitations, you want a little bit of volatility in your life, take a position in Hims and wait for the $30 move. It's a very strange story, but they effectively have so obviously their main business model, I don't know, obviously you might not know, but their main business model was erectile dysfunction pills. Then I think they got into hair pills, so selling stuff to help people regrow their hair, which seems to be the package deal. And then they're able to use basically a generic version of Novo's weight loss drug, kind of an Ozempic type of deal. And that's what catalyzed their massive upside. But they were only able to do that because of sort of this temporary regulation that had expired. And so now the market can't figure out how to value them and whether or not they're going to get an exception from Novo to offer these drugs and continue this business line or not. So they're all over the place. It's decently liquid. It's not the best, but it's decent. 15 cents at the money's in July. I told you, it's not the best, but it's decent, and it's going all over the place. But I told you, this is part of my globalist basket. You're gonna have to pay to conceive one day. Self-Omaha. I get it. Mark says, yes, Victor, Hims goes up and down. Zing. Tom Banjo says, Hims is snake oil. I think the biggest problem with this company is it's so easy to destroy this business. They really don't have a moat. And there was a time, one of these big crashes in Hims stock was the idea, I think Jeff Bezos and Amazon at some point was going to get into this business model. And I believe they have. So it's so easy to just completely destroy this business. There is no moat other than their brand recognition. But I think if Amazon wants to sell these things at a quarter of the price, it doesn't matter if people know your name or not. They're going to outcompete you and you're going to disappear. So I think that's their biggest problem right now. Maybe their best bet is to just try to get Amazon to buy them. I don't think it's snake oil. I mean, people buy. I mean, the reason I think, okay, I make the joke you have to pay to conceive. That's not really it. So what over the last, I think it's 50 years, male testosterone has been dropping at an annual pace of 2% per annum. And I think that has a lot of implications. And so, there's a part of me that goes, okay, well, what are the effects of male testosterone dropping 2% annually for the last 50 years? What are the effects of that? And at one point, in a different life, maybe I'm, some social activist that tries to bring attention to this matter, tries to change certain aspects of the food supply. I try to help people understand the importance of filtering their water, or maybe we go out there and we get those forever chemicals out of the water, the birth control that's in it, change diet, improve exercise. Maybe there's a world where I'm some social activist and I go to try to create social change. But I don't know, that life is not this one. So then I go, well, if these are the obvious impacts of what I believe are environmental externalities that will be very difficult to change, what happens? Well, more people have to buy stuff like this at an earlier and earlier age and use it for longer and longer periods of their lives. So that was sort of like some small part of the investing thesis a long time ago. Yeah. Herb Immunity says, nah, man, I just let my body filter the water. Yeah, bro. That's so funny. Pfizer has no lifeline, my guy. But this is the thing, Katan. I don't disagree with you. It's just, what are you investing for? You know, you're either investing for high growth. You know, if you want high growth or interesting names, you go to biotech, right? But if you're investing in just a theme that's going to attract capital flows, you go to the liquidity sponges. And Pfizer's a liquidity sponge with a gigantic regulatory moat. Pfizer has effectively captured large swaths of our health regulation. So I always think those are tends to be a decent bet. Like this, the sucker's bet is to sell a Boeing plane that falls out of the sky. And I mean this, I'm not trying to say this with no empathy to those that lost their lives most recently in India. I think the Indian flight. But and I hate that I think this way, but in a weird way, participating in markets for nearly 20 years have like rewired my brain to think this way. But like the worst thing you can possibly do, I don't say that, it is a sucker's bet to sell a Boeing plane, sell Boeing stock based on a negative news headline, like on an individual flight. It is a sucker's bet every time, every single time. There is no competition for Boeing. They are also a defense contractor. They disappeared a whistleblower and a key witness last year. Like they're playing a different game at their level, bro. Like there is no competition. At some point in time, SpaceX might get into commercial airlines. And I know people are like, well, no, we got Airbus. Yeah, we got Airbus. And we also have a nationalist movement in this country and a nationalist president that wants people buying American goods right now. Do you think a Boeing plane falling out of the sky is going to change that? No way. So not only did it not change that, but we just negotiated a deal with the UK that gives Boeing preferential pricing on airline equipment. Like, I never understood that and again, I don't mean to ignore the humanity of those events and the lost lives and the tragedies that those events are. I'm just speaking about it through a pure capitalist point of view right now. And I kept saying throughout all that period, if you go watch my Twitter, I was saying, I was accumulating stock and I was talking about it through Twitter throughout that whole thing. And now we're back up to 220 because there is no alternative when it comes to Boeing. Right now, there is no alternative, my friends. And when you disappear a whistleblower and nobody cares, nobody cared. They did it in broad daylight and you all know they did it and nothing happened. All right. Sorry about that. Who said Viking Therapeutic? I just saw that. Katana, are you in Viking Therapeutics? All right. SLG says, Victor, I should probably pre-read these, but let's just go with it. Victor, since you were talking about nationalism, then what are your thoughts on USAR? They are trying to go vertical on rare earth minerals and magnets. No idea. No idea. I'll have to look. Let's talk this week, Bunker Talk. Highest time in America is the Talk on Military podcast. Yeah. I was trying to, Mark, I was trying to turn a new leaf today. I was trying to talk stocks. I was trying to, smile and stay positive, and you want to pull me back in. You want to pull me down into the muck. This one's wild. I totally missed this one. I'll go a little darker later, but for now, I totally missed this one, and I'm kicking myself. There was a point. There was last week when I looked at this. I looked at Nike, and I was like, should I? Just because it was so cheap. And I think I sort of talked myself out of it. That like now, people aren't ready to buy this stuff again. And man, was I wrong. What a move in Nike from $60 up to $72.50. A little bit of a breather today, but not much of one. Totally filled this gap. Kicking myself. Always buy the dogs, Victor. Always buy the dogs. That's basically my whole thing. What does everyone else hate? And can I get it cheaply? This Albemarle's getting cheap again. For whatever reason, I know the reason, I suppose, but the electric theme has totally fallen out of favor post-election, almost exactly post-election. Here's your November 2024, and you see what happens to Albemarle. This is a lithium provider, but if you were to look at a lot of other stocks, except Tesla had this really crazy run post-election, but a lot of the electricity theme has just gone out of favor. This is the best one to look at. It's had a little bit of a resurgence over the last month or so. Yeah, see this PBW? I kind of like, I think I should buy some more Albemarle. Sometimes I feel like a straight boomer with some of the things that I buy. A straight boomer. Lithium. Meanwhile, we're living through like the greatest what they tell me is the greatest technological revolution of all time, the most important invention since the internet, since telecommunications, since fire, since the wheel. And I'm over here going, I know lithium's in a glut for the next couple of years, but maybe I should buy some more Albemarle. Meanwhile, Nvidia's hitting all-time highs. What's wrong with me? What's wrong? I haven't even talked about AI at all. And I won't. Nvidia up 15 basis points, nearly 160. Just stick the knife in, man. I'm over here trying to do my best, like value plays. Meanwhile, the trade for my entire adult life was just buy tech stocks, buy the liquidity sponge tech stocks, just buy out of the money calls, in the money calls, doesn't matter. Just buy them and wait. Don't do anything else. For my entire adult life, that's been the trade. And some part of me is just so angry at all the people that I see around me who did that, who did no risk mitigation at all. They couldn't tell you what a distribution curve is. They couldn't tell you what a non-correlated asset is. They just bought Facebook and Nvidia and Apple and Google, and they're on an island somewhere. Meanwhile, I'm doing all this deep research and these formulas. eking out a few basis points every day. You know how infuriating that's been? Me and Nick talked about that one time. It's absolutely infuriating. He's just somebody who came in and was like, I'm going to buy this magical internet money at $50. And you're like, well, I don't know if I would do that. You should spread your money out and diversify yourself. Let's talk about correlations, and the Federal Reserve might cut more than. It's like, bro, I'm buying the dog money. Leave me alone. Now they're a billionaire. Now they're a billionaire with their own YouTube channel that has millions of subscribers, and they want to know which shitcoin they're going to buy next. That's the world we've created. Again, I've said this a few times in the past. There's a guy, his name's David Morgan. He is a silver stacker. Basically, he's one of these guys that was talking about hard money before it was a popular thing, before the Bitcoin explosion. He's an OG in that game. I had the opportunity to do a podcast with him years ago, and he said this thing I've never forgot this quote. He said, "A society is only as honest as its money." And I've thought about that quote and its meaning, its implications. I don't know, man. Hours at this point. I probably mentioned it maybe close to 10 times now. I have never forgotten that quote. A society is only as honest as its money. And the more dishonest the money becomes, and the more shell games we play with the money, you see it, because the incentive is the root. So you pervert the incentive, you pervert the root level, everything around it will be impacted. And I thought, as soon as he said that, I thought, what a profound statement. Never forgotten that. All right, let's keep cruising here. I'm kind of betting the farm. I could really use another Tesla pump. I don't know if this is just dead money. But I've got a pretty decent position size in Tesla. I was long some upside call spreads, scaled out of them, and then I let one or two expire in the money between the strikes, meaning so I ended up with a long stock position in Tesla, which I don't normally have. And usually I'll offset that and I'll bring my portfolio deltas down, or I'll spread around the risk. But I'm not doing that right now. And for the life of me, I can't tell you why. Maybe it's a bit of greed. But I do kind of like the bet. I think as soon as he took a step back from Doge, I was like, all right, they're going to stop. He's going to disappear from the news, basically, because he's only in the news because they're trying to gin up everyone to get angry at him, to put pressure on them politically. And as soon as he steps back, there's no reason to do that anymore. And surprise, surprise, you don't hear a damn thing about Elon Musk anymore. Nobody's setting his dealerships on. Isn't that funny? Nobody thinks about this stuff. Nobody cares about Elon Musk as soon as he says, okay, I'm going to step back from the government. Why is that, people? Don't you think that's funny? Don't you think it's weird that this dude was just in everyone's feeds for a while when he was combing through the government's affairs? Then all of a sudden he says, okay, you can close the checkbook. I'll step away. And no, now nobody cares. Isn't that strange? Manufacturing consent. If you haven't read it, go read it. And you don't even have to read the whole book. You can probably read the first couple of chapters to understand the gist. And if you haven't read it, reading those first couple of chapters will probably change the way you see all media afterwards. Let's keep going. I made a ton. Tiago says, I made a ton on Fartcoin, Vic. Been saying this to you for some time. 100% you did. I've seen them. I've seen you say that in here. And Sometimes I thought you're being facetious, but some part of me was like, oh, I think he's serious, and I've laughed a couple of times. But 100% you're right, Tiago, and I'm not mad at it. I'm not mad at all. One of these days, I'm just going to come in here and let it ride. I'm going to go Black 13, and we're going to see if we're going to hit. I think that's what happens. I think most people that end up blowing out, they just get to this point where they're tired of waiting, and then they know they shouldn't do the thing, but they do the thing, and then it ends the way you would think it ends. They just go, I'm tired of waiting. And they put it all on a bet. Trying to double down, disappears, and they never come back. I guess since it's Monday, we can do our look ahead for the week. Obviously, it's a shortened week, so markets only open half a day on Thursday and then closed on Friday. I believe the futures are going to be open, though. They'll tick until noon on Friday, so there will be a little bit of movement. We've got some pretty decent data for a light week, a shortened week. Jerome Powell's going to talk tomorrow. Yay. PMIs, ISMs, JOLTS tomorrow. All this stuff is early. I think JOLTS usually comes out on a Wednesday, if I'm not mistaken. I might be wrong on that, but the employment report is going to come out on Thursday. It usually comes out on Friday, so it's a day ahead given the holiday. Mortgage applications, normal time on Wednesday. Motor vehicle sales, we're going to get a bunch of Tesla delivery numbers. Did we already get them? Is that why they had a 2% dip? I didn't catch that in my prep. And I apologize. I should know that offhand. I don't think so, though. Yeah, I don't think they're out, but we should get Tesla delivery numbers. I'm guessing they're not going to be good. Let's see here. Wednesday, with all of the motor vehicle sales, we'll get the delivery numbers. I got a decision to make. Do I keep the risk on, or do I hedge it off? Do we play a little? Do we gamble a little this week? Delivery numbers will be weak, but the question is weaker than expected or not. I'll read you the headline of this article. Tesla delivery numbers are out this week. Analysts think it will be a bloodbath. That's the headline, I swear. Analysts on average are expecting Tesla's biggest year-over-year quarterly decline ever. Yeah, obviously. So this is, I kind of like these moments, right? I like when everyone expects them to be bad, because then it's in the price. And if they're just not as bad as expected, then you get a rally and people are confused. I love lowered expectations. There's nothing better in the market than lowered expectations. See here, Tesla's reporting Q2 deliveries Wednesday, and judging from the leading indicators and analyst estimates, not looking good for electric car maker. Monthly sales have been dropping across Tesla's biggest markets, including the US, China, and Europe. Why do I do this to myself? The company's most successful robotaxi launch last week isn't likely to move the needle on vehicle sales, obviously, which make up the lion's share of Tesla's revenue. After all, the launch only includes 10 to 20 sort of autonomous cars whose technology is not yet available in the wider Tesla fleet. Ooh, what do we do, chat? What do we do, chat? Jay Powell is now Donna. Whoa. Donna says Jay Powell is dead to me. Why is that? Why is that? I'm down. I like the messiness. I'm kind of liking this whole messiness between the president and the chairman of the Federal Reserve. I mean, say what you want, but people I saw people on Twitter calling him the greatest Fed chairman of our time, and I'm like, that's an oxymoron. Bro, that dude lit our money on fire, man. It will never be the same. We increased the money supply by 27% in 1 year. That's unheard of. Over the sniffles. Don't get mad at me. Sorry, give me just a second. I'm trying to bring up a poly market, and I can only do it on my phone because gambling sites in Singapore are restricted. So on my phone, I can get to it, but on my computer, I'm not. So I'm not just like off texting or something like this. I wanted to get this market, the poly market, for will Trump remove Jerome Powell in 2025? The odds right now are 14%, but they have spiked up to 20%. And I think that's a sucker's bet. I do not think he will remove him. I think he might try to jawbone him into resigning early. I don't think he's going to try to remove him. It's not worth it. The juice isn't worth the squeeze. He's going to get caught up in court. And by the time it's settled in court, his term is going to be over anyway. So I think that poly market for will he remove him at 15%, it's a sucker's bet. So I would tend to sell it. I don't think you're getting paid a lot at 15% though. But if it spikes, like if anytime Trump tweets about Powell, it'll probably spike. You might get a spike up to 20, and then I would sell it at 20. Because I don't think the juice is worth the squeeze. I do think he's going to jawbone him into trying to get him to resign early. I think he will do that as long as he can get away with it. In other words, if he jawbones Jerome Powell into resigning early, and you get a little bit of a tantrum in rates, then he's not going to do it. But I don't know that you will get a tantrum in rates because the market is forecasting sort of a dovish replacement. So it just depends. And I think that's one of the most interesting tells about the long end of the curve right now. That if you take us back to April, when the president was jawboning Jerome Powell, or sort of intimating that his termination can't come fast enough, just the idea of sort of an uncertain monetary policy back in April, at the same time we had uncertain global trade, the bond market threw a fit over that tweet, and he walked it back a couple of days later. If you remember, I think he said it on a Thursday or Friday over the weekend. He comes back on Monday and he was like, I wasn't threatening to fire him. I was just saying his term ends in 2026, and that can't come fast enough. So he walked it back, and he walked it back because it created an issue with long-term interest rates. And I think as long as he can jawbone and not have a tantrum in rates, he's going to do it, and he's going to do it more often. And I think there's a little bit of a tell in the fact that we're having that same uncertainty in monetary policy right now, but long ends are not throwing a tantrum. It does really seem like we are in a slightly different demand environment for long end of the U.S. Treasuries than we were in April, ever so slightly. I could be wrong and misreading it. Could be tons of other reasons, but I do think just the termination can't come fast enough line was enough to throw bonds, create some bond volatility. Now he's openly saying, he's flirting with the idea. He's calling him a loser. He's too late. He's like, every day he's riding him, and he's doing it because the long end is letting him. The bond market's letting him get away with it. But if that's true, there might be something to the idea that he might be too late. You know, he might be too late. There might be demand for the long end, which is why I can't wait for September. You know, I really need to get out more, but like September for me is going to be, I'm psyched for two reasons. One, Canelo Alvarez is going to be fighting Terrence Crawford in September. And then two, we're going to get the FOMC meeting, and hopefully we're going to cut and figure out if we should be cutting. I don't really think we should be cutting, by the way. I don't think we should cut. But I'm kind of crazy, and I think we have done so much damage to our economy with our COVID response that we need to normalize it. Otherwise, we're going to live in just a funny money world for the rest of our lives. But nobody wants that. Let's see here. All right. Tom says, I have a propensity to double down again and again and again and again. Yeah, that's a rough one, Tom. I guess the way that I solve that problem for me is I significantly reduce my trade size on first entry. So basically, I almost always assume I'm wrong about my entry point. So if I convince myself that you're picking the wrong price, it puts me in this mental space that says, okay, how many bullets do I want to fire? So maybe that's 5 bullets, or maybe it'll be 10 bullets. It's usually something along that line. So then if I say, let's say 10 bullets, so whatever my max position size is, would only be acquired after 10 buys. So that means my first entry is going to be 1/10 of what I would have wanted my position size ultimately to be, because I've convinced myself I am going to enter at the wrong price. And so then mentally I'm prepared for lower prices. And also from a risk perspective, I'm prepared for lower prices and to double down or to layer in. Basically, diversifying entry price is a fancy way to say that. So yeah, that kind of helped me, like psychologically. Just I always convince myself it is the wrong price. And that way, when it goes against me, I'm excited because I get to enter the additional tranches of my position. And I actually get bummed out when it goes the direction I wanted it to, because I don't have the largest position size that I want. So in some ways it doesn't pay off because I have smaller positions on immediate winners, but more often than not, I'm able to get off a few more entries and psychologically prepare myself for markets to go against me. Grumpy Mike says, I want 1993 back. You and I both. How old was I? 93. I think I was 7 years old. I think I was in first grade or something like that. We might get 1980s 20% rates. No way. There is no chance. I like 8% rates would basically just clear everything out. It would clear everything out. We are 4 times levered in the global economy right now. There's no chance of getting to 20% rates. Everything would be destroyed. I think at 8%, 8% is sort of like this functional equivalent. Technically, if you think about it, it's four times levered. So it means a 5% rate today is kind of like a 20% in 1980. Sort of. I know it's not exact, and that's not exactly the way we want to think about it, but it is. That's why 5%, it's like everyone's hair catches on fire when we get to 5%, because everyone knows we're in a 4 times levered economy. At high rates, it's almost unsustainable. So if you could imagine like an 8, 9, 10% treasury, bro, like nothing's moving, everything's dead. So 20%, I don't know. I don't even know how you'd get there. That's like, in a movie, this is going to get dark, but in a movie, somebody or a video game, you shoot something and it falls down. It's like you don't have to keep shooting the body on the ground. 20% is like shooting the body 10 more times than you needed to. That's a crime of passion. That's what they call those. All right. Let's see if you got any more, and then we'll sign off here. D-Chat says, oh, you got the similar strategy. Minimum of 3 buys to build a position, 50%, 30%, 20%. I do them opposite. So I'm kind of similar. Sometimes I usually do more than 3, and I'll do the smaller end first. Like I'll do the 20%, then the 30%, then the 50%. I don't really use these splits, but if I were doing it, it would reverse because when you get cheaper and cheaper prices, but you're entering in with a smaller position, you're, in my head, I'm not taking advantage of the cheaper price. I'm not scaling my cost basis down as quickly as I could. If I flip it, if I go to 20% and I get cheaper prices and go with a bigger position size, I'm taking more advantage of the cheaper price. Then it goes cheaper again and I get my 50% off at a even cheaper price. I'm taking my cost basis down much more than I would if I flipped them. Catan, Victor, wow, bunker talk. I'm only responding to the comment here. Mark said we might get 1980s 20% rates. I'm just responding to it. I guess shooting the body is the bunker talk. Yeah, I know it was dark. I couldn't think of a better analogy. My apologies. All right, everybody, that's going to do it for us. Shoot my trading account, says Mark. I never averaged down, so we were doing similar. I see, D-Chat. I got it. All right, everybody, that's going to do it for us. This was a fun one. We didn't go too political, I don't think, and we did a lot more symbols than usual. Talked about a bunch of themes. Decent start to the week. Tom Banjo says Tesla's grossly overvalued. I agree. I don't know what I'm doing. I probably need to hedge off that risk. I'll figure out the cheapest way to hedge my downside, leave my upside open. That's what I'm doing. All right, everybody. I will see you back here tomorrow. We're going to have our regular schedule, I believe. So we've got our conversations lined up with Ilya and Chris this week, if I'm not mistaken. So I'll see you back here. Same time, same place, same great network, only on Tasty Live. Until then, peace.